Good morning, and welcome to the CFTC's Agricultural Advisory Committee meeting. As the designated federal officer and acting chair of this committee, I note that we have a quorum with 34 members currently present either in person or virtually, and I hereby call this meeting to order. I would like to extend a warm welcome to Chairman Benham, who is the sponsor of this committee, and Commissioners Johnson, Goldsmith, Romero, and Mersinger for attending today's meeting with us today. This is the first Agricultural Advisory Committee meeting with Chairman Benham as the sponsor. I'd also like to thank our members and our guest speakers for being with us today. To begin the meeting, we are pleased to first recognize Chairman Benham for his opening remarks, followed by the commissioners. Chairman Benham.
Thanks, Bridget. Good morning, everyone. This might take a while because, as Bridget pointed out, it's been a long time since we've gotten together, so I do want to thank everyone for being here. I want to thank the new members, but I will say all this in my prepared remarks, and look forward to saying hello to everyone individually as we have a few breaks between now and the close. So with that, good morning and welcome to the first Agricultural Advisory Committee meeting of 2022. The AAC fortifies the strong connection between the CFTC and its historic responsibilities in ensuring that America's farmers, ranchers, manufacturers, and other commercial end users continue to have cost-effective access to CFTC-regulated markets to manage risk, and provides an active forum to discuss and address emerging issues and impacts to the agricultural markets in near real time. Before we move into the substance of today's meetings, I do want to thank Commissioners Johnson, Goldsmith, Romero, Mersinger, and Pham for participating today, and of course for their contributions to this discussion. I also want to thank today's presenters and panelists. As you know, we've gathered together a distinguished group of speakers, and their readiness to participate is greatly appreciated. And I also want to thank Bridget Wiles, the committee's designated federal officer. Bridget joined the commission back in 2008 and brings a wealth of market knowledge and experience to the AAC, so I think we should all be very confident in her ability to lead this committee and share ideas that we all have and care about collectively. Again, I want to thank all of you for being here. Today we welcome many new members to the committee, which was recently reconstituted following its September 2021 expiration. You're here today representing a broad range of interests and perspectives which illustrate the diversity of our ag markets, from producers to consumers, credit servicers, major market participants, including derivatives market intermediaries and exchanges, and representatives from the U.S. Department of Agriculture. Our 35 members will draw on the depth and breadth of their market expertise to provide diverse and invaluable insight into the issues of greatest impact and concern. I understand that your service on this committee is in addition to many obligations, both at work and at home, and I appreciate your commitment to ensuring that the CFTC remains fully informed as to what is affecting members and participants in our ag markets, so that as we consider regulatory policy, we take steps aimed at addressing these issues and within market structure. Our efforts are targeted and effective. I look forward to continuing the important work of this committee. The committee last met in June of 2021, the time we were beginning to recover from the pandemic and examining the uncertainty of significance of supply chain disruptions. Since then, significant volatility has remained a fixture in many of the ag markets due to the ongoing recovery as well as growing impacts of extreme weather and geopolitics. To provide baseline for us to consider throughout today's meetings, we'll begin by a presentation by Dr. Cynthia Nickerson, Deputy Chief Economist with the Department of Agriculture, on the ag economy with a focus on the impacts of weather-related and geopolitical events. Extreme weather events in the U.S. and across the globe continue to impact crop and livestock production, resulting in supply shortages and price increases on everything from butter to baby formula. For example, at the AAC's last convening, David Rosen, Global Hedging Manager for Cotton at Louis Dreyfus, reported that global futures and cash prices for cotton had plummeted when the textile industry ground to an abrupt halt during the pandemic. Now, droughts worldwide are causing the smallest cotton yields in over a decade, with prices increasing, but tempered in part by warehouse supplies. However, the lost crops is devastating. While crop insurance helps farmers, thousands of jobs throughout the supply chain will be affected, from farm workers and truckers to cotton gins and warehouses. It all then trickles down through the economy to the small town businesses where impacted employees spend their paychecks to the regional banks that hold their mortgages and auto loans. Even if crop yields rebound, affected regions such as the Texas High Plains will take years to recover, especially in small towns whose economies are especially dependent on cotton. The livestock markets are also being hit hard by extreme and unpredictable weather, and the impacts will likely be felt for years to come, with ranchers making the difficult choices between bringing in expensive feed to supplement pasture loss or thinning their herd. This year, the livestock market has reportedly auctioned off nearly 20% more cattle than it did at this point last year. With so many ranchers selling animals ahead of schedule, predicted cattle shortages will likely mean higher beef prices in the future. There are, however, sustainable agricultural plans and programs being implemented by stakeholders across the ag community to address these issues, and we will explore sustainability in the agricultural supply chain with a presentation by Scott Herndon, president of Field to Market. As severe drought continues to cut river traffic through vital transportation arteries like the Mississippi River Basin, half of all U.S. grain exports and roughly 500 million tons of goods annually are estimated to be impacted, which could cost the economy $20 billion in damages and losses. With a majority of food distribution in the U.S. being tied to the river at some point, this suggests that cost increases to shipping companies will ultimately reach consumers at the grocery store. And again, there are impacts to cities all along the river whose workers and businesses depend on the steady flow of traffic. Since droughts historically occur less frequently than floods, it's been pointed out that federal resources and alternative compensation are simply not available to businesses that are equally harmed by drought. As the frequency of these extreme weather events picks up, there's an increasing call for policy solution at the national level. On these issues, we will hear from Jessica Stiffen, Chair, National Grain and Feed Association, Waterborne Commerce Committee, and former CFTC Commissioner Tom Erickson of Erickson Law and Consulting on the increasingly critical domestic and international shipping, freight, and storage impacts of the grain trade. The impacts of weather and the fallout from the pandemic have been amplified this year by geopolitical events. Russia's aggression against Ukraine has led to extreme uncertainty in the global markets for energy, agricultural, and metals, often leading to unanticipated movements in commodity prices because of shifting market sentiment. Any decision at any time can and could move markets in extreme ways. This is coupled with shifting monetary policy tightening by the U.S. Federal Reserve and other principled economies around the world, aimed at slowing inflation levels, and in doing that, resulting in macroeconomic effects on the same commodities and associated consumer and producers more generally. Price movements in these markets are, for those outside of this country, further affected by exchange rates, with the U.S. dollar recently rising to a 20-year high against many other major currencies, putting additional upward pressure on price increases. While this trend may provide an offset to inflationary pressure for companies that rely on overseas sales and exports for revenues, a strong dollar environment can mean lower earnings, compounding the negative impacts of higher U.S. interest rates and inflation. Supply-side decisions bring us to a final factor in energy price pressure and uncertainty, with OPEC's recent decision to decrease production by 2 million barrels per day, even while the Ukraine invasion continues having knock-on effects across all commodities. According to the OECD, Russia's aggression against Ukraine has undermined the latter's capacity to harvest and export crops, sunflower seed and wheat among them. Russia plays a key role in global energy and fertilizer markets, acting as the world's top exporter of natural gas and nitrogen fertilizers, and the second and third leading supplier of potassium and phosphorus fertilizers, respectively. Since the agri-food sector is highly energy intensive, the reduced export capacity and rising energy and fertilizer prices translates into higher production costs, further increasing food prices and threatening global food insecurity. What does this all mean for agricultural derivatives markets when it comes to the potential for market disruption? Later this morning, we'll hear from Tim Andreessen, Managing Director for Ag Products at CME Group, with an overview of how the agricultural derivatives markets have addressed the impact of these geopolitical events through evolving price limits in the agricultural markets. Understanding and discussing the impacts of extreme weather events and geopolitics and the ongoing recovery from the pandemic and how these market forces will continue to impact American farmers, ranchers, and other market participants throughout the ag supply chain is crucial and highlights the importance of this committee. We have an aggressive agenda for our short meeting today, and I look forward to hearing from all of you during the discussions that accompany each presentation. And I also look forward to using our last session of the day to scope the AAC's agenda for 2023. Before moving forward and looking back on the last several years of historically high volatility in response to the global pandemic, various extreme weather events, and geopolitical issues, the ag futures markets have continuously provided transparent price discovery and accurately reflected supply and demand fundamentals with convergence at expiration. Our goal should not be limited to ensuring that the derivatives markets continue to serve their risk management and price basis functions. We should examine and explore ways that we can build even greater resilience, usability, access, and availability into our markets and market structures so that the benefits can reach the widest breadth of potential users and market participants. If there are ways in which our coming together can benefit the ag community beyond direct derivatives market participants, whether through developing policy recommendations or through strategic partnerships, then we should all collectively explore these issues and opportunities. Again, I want to thank all of you and for being here today, our participants, our distinguished guests, and of course my colleagues at the CFTC who have worked in front of and behind the scenes to bring this meeting together. Thanks, and look forward to the discussion.
Thank you, Chairman Benham. Commissioner Johnson?
Good morning. I'm so pleased to welcome so many of you joining us in the building today and virtually for the Agricultural Advisory Committee meeting. I want to thank Chair Benham and Bridget Wiles, designated federal officer for the ACC, for their efforts to organize today's meeting. I look forward to hearing from and learning so much from each of you today about the topics outlined in our meeting agenda. The CFTC's role in price discovery and market oversight is critical to ensuring the stability and integrity of agricultural markets. The safety and soundness of agricultural markets is a top priority for this commission, and this commitment is especially critical during times characterized by persistent volatility and risk, inflation, and geopolitical events that deeply impact the prices paid for raw materials and basic resources that fuel production in agricultural markets, as well as pricing of deliverables. The Commission plays a key role in reducing market volatility and mitigating risk by ensuring that our derivatives markets are fair and transparent, promoting responsible innovation and protecting end users through enforcement. Over the last several years, as the chair mentioned, and each of you is deeply familiar with, the impact of the continuing COVID pandemic, geopolitical events in Europe, inflation, and a number of other macroeconomic conditions have led to increasing unpredictability in the prices for agricultural commodities and food insecurity in a number of regions around the world. On March 11, 2020, the World Health Organization declared COVID-19 a global pandemic. In the period immediately prior to and following WHO's declaration, markets witnessed unprecedented volatility in the prices for critical inputs. For nearly 3 years following this announcement and the onset of COVID-19, speculation, uncertainty, and volatility have continued to characterize markets. The sustained periods of volatility have created enormous pressure for many markets and unique challenges for agricultural markets, disrupting supply chains, prompting surges in demand for agricultural resources or periods of decline in prices, and reducing fundamental supplies. Coupled with these events, the pandemic, geopolitical events, including Russia's invasion of Ukraine, have triggered further disruptions. For months, we've witnessed precarious uncertainty surrounding the production, distribution, and pricing of a basic food source, wheat. Reduced access to energy exacerbated production and distribution challenges. A sustained drought, including limited transport along the Mississippi River and skyrocketing prices for fertilizer, have created further challenges. Other factors have also contributed to the tightening of supply and the rise of prices, including challenges in China's pandemic response. I'd highlight at this point that many of you are tremendously familiar with all of these issues, but I'd like to acknowledge comments raised by a few of you in particular who have been here to visit us at the CFTC since we arrived, our newly impaneled commission. Commodities are vital for livestock feed that have also been deeply impacted. For instance, global wheat production creates challenges for producers of many agricultural products. We are thoughtful about the extent to which we spent time here at the CFTC meeting with the National Farmers Cooperative and others discussing some of these challenges. If we begin at the beginning, we would note that the CFTC's oversight of agricultural commodities began almost a century ago, when Congress enacted the Grain Futures Act in 1922 and later expanded oversight with the adoption of the Commodities Exchange Act in 1936. Thereafter, Congress has continued to reinforce its expectation of our commitment to oversee and monitor pricing and risk in these markets. The Commission, as I noted, plays a critical role in derivatives markets by overseeing exchanges that allow for price discovery and risk mitigation in futures, options, and swaps markets. The CFTC's mission is to protect and ensure orderly markets, foster, as I mentioned, responsible innovation. And to achieve these goals, the CFTC has a number of specific responsibilities that I am personally committed to ensuring we effectively evaluate over the course of our tenure as a commission. Monitoring trading activity, conducting investigations into potential violations of the CEA, educating the public, and providing guidance to market participants. The CFTC collaborates with a number of financial market regulators around the world, as the chair intimated in his opening remarks. And we also are deeply thoughtful about the necessity of engaging all stakeholders as we're mindful about the creation of policy and its impact on markets. Today, agricultural markets face new challenges, but remain resilient due to market structures and principles established over 100 years ago. When the question arises of how we're going to feed the world's 9 billion people, all eyes turn to this community. I'd also just note quickly that the CFTC's work in this space, as we engage all stakeholders, must contribute to the building of a sustainable future. The Commission must work with all stakeholders to promote responsible innovation that effectively ensures sustainability. The American Farm Bureau Federation reports that greenhouse gas emissions are going down in the livestock sector as farm efficiencies increase. The AFBF also notes that American farmers and ranchers are leading the way in sustainable practices that reduce emissions, enrich soil, and protect our water and air while producing more fiber, food, and renewable fuel than ever before. To build a sustainable future, we must all work together. We must maintain an open dialogue with all stakeholders to find innovative solutions that address the macroeconomic challenges that face the agricultural industry today. To ensure the Commission's policy decisions are well informed, this and many other discussions are necessary. A part of the Commission's mandate is to support the community that is represented here in the diverse stakeholders and voices around this table and joining us virtually. Innovation is important, but it shouldn't come with the negative costly impacts that harm commercial end users and hedgers. I want to highlight here that I spent some significant portion of the summer, a week, traveling through Texas, visiting farmers and ranchers, and discussing with them the challenges that they faced in the context of ensuring sufficient fertilizer for crops, in the context of ensuring or making hard decisions about how best to use the resources that are available to them. One farmer, a really fantastic woman who's taken over her family's, a rancher, sorry, who's taken over responsibility for her family's ranch, described the very difficult decision to continue with production as they have over the last several years, or, as the chair intimated, to acknowledge the challenges and costs of feed, and as a result, reduce their livestock inventory. I believe that there are a number of policy approaches that could have a positive impact in the agricultural community. I'm excited to work with the chair and the members of the AAC as we begin to discuss and explore some of those solutions today. In addition, the Commission has undertaken, under the chair's leadership, a number of initiatives that I believe are important and directly impact the agricultural industry. I believe the agricultural industry is in a unique position to inform our thinking about a number of issues that we've began as a commission to explore, including our RFI soliciting feedback from the community on the best ways to attempt to address climate-related risks that face our markets, as well as the voluntary carbon market convening held earlier this year on June 2nd. I'm grateful that the chair is deeply thoughtful about ensuring that the community's voice is heard and included in these discussions. I believe that any legitimate solutions and long-standing sustainable solutions will be the result of the conversations we have today and many others. The Commission is deeply thoughtful about the extent to which emerging technologies will impact all of our markets, agricultural markets included, in the long run. I believe it's important that we think carefully about efficient and cost-effective ways to transport and track commodities across the global economy, but we must also be mindful of the dangers presented by these emerging technologies such as blockchain and digital assets. In conclusion, I believe a key to building a sustainable, vibrant agricultural market is for the Commission to do as we are doing today, to engage directly with stakeholders, to ensure our derivatives markets are fair and transparent, promote responsible innovation, and aggressively pursue bad actors. I again thank the Chair for his leadership and my fellow commissioners, as well as Bridget and the AAC members for joining us in today's meeting. I look forward to hearing from many of you and learning so very much about the issues that are deeply impacting our agricultural markets.
Thank you, Commissioner Johnson. Commissioner Mersinger?
Good morning. It's great to see so many folks here in person, and also those of you that are joining us virtually. I appreciate having everyone here today. I want to say thank you to the chairman for holding this important meeting. There are a lot of topics to discuss today, and I'm certain the meeting will be extremely interesting, and I'm looking forward to hearing from those who will present before the advisory committee. As many of you know, the agriculture derivatives markets we regulate here at the CFTC are near and dear to me. The agricultural markets are truly the backbone of this agency, just like agriculture is the backbone of our economy. Well-functioning agriculture derivatives markets have a direct impact on the prices for consumers, from everything to the hamburger that you buy at a fast food restaurant to the cup of coffee many of us require to start our day, or maybe 2 or 3. These issues certainly relate to, they're truly pocketbook issues that hit everyday Americans. Today's agenda for the AAC hits on a number of issues that are top of mind for those in production agriculture. From the economic impact agriculture faces from extreme weather to the risk of market destabilization caused by unpredictable geopolitical events, the topics discussed today will paint a picture of the hardships and hurdles that the sector must face day in and day out. I know I've said this before, many of you know that I grew up on a farm where my family is still back in South Dakota farming. And I remember when my dad would come home at night from the fields, if I was still awake, I would often ask him, how was your day? How did today go? And if many of you who have been around the farm community and farmers will know the answer is usually something like, well, hopefully tomorrow's better. And I used to get really upset and say, can't you be more optimistic? You know, it's a very pessimistic outlook on life. But the more I think about it, I actually think that's a very positive perspective. My dad knew that the storm clouds would clear. He knew that the yields would increase, and he knew that prices would eventually go up. And I think anyone in production agriculture, you have to have a positive outlook on the future. Otherwise, you'd probably give up on farming the first year you were involved. But with so many factors out of your control, optimism might seem misguided. But it's really the grit and strength of those in the agriculture industry that keeps them going in the rough times. I think it's also the ingenuity in this field of the economy, which brings about new technology advances that improves everything from the types of seeds that are planted to the equipment used to harvest. This ingenuity is also at work in identifying new ways of farming and new opportunities for revenue on the farm. And I believe we will see this reflected in the presentation on sustainable agriculture today. Finally, our role at the CFTC is to make sure that agriculture's futures markets serve their role with price discovery and risk mitigation. Hearing directly from the exchange about price limits and how they've evolved in the ag markets, and fully understanding how well those markets are meeting their intended goals, especially during volatile times, will be very helpful, and I appreciate the focus on that today in the agenda. Each of the 5 advisory committees at the CFTC provides numerous benefits to the public and to this agency. And as I've said before, government regulation without public stakeholder input is destined to fail. The AAC provides a meaningful forum for the Commission to learn from those intimately and significantly involved in the production of food and fiber here in the U.S. and around the world. So again, I want to say thank you to Chairman Benham for convening today's meeting. Thank you to all the staff here at the CFTC who make these meetings possible. Special thank you to Bridget, the new designated federal officer of the AAC. Bridget, I would like to say you have big shoes to fill, but that seems kind of self-serving. And last but not least, thank you to all of you who are here. We value your input, the support of our mission at the CFTC, and we are grateful for your public service. Thank you.
Thank you, Commissioner Mersinger. Commissioner Goldsmith-Romero?
Hello, isn't it great to be here together? I think it's terrific that you made the effort to come, and it makes a difference. It makes a difference to be here together. It makes a difference to talk about these things, to be in the same room, even those who are appearing virtually. It's good to get together and talk about these things because these are markets that are facing significant challenges, and this is an agricultural sector that faces significant challenges right now. Thank you, Chairman Benham and Bridget and all of the staff who've worked hard to get us here together. As I went around the room this morning and met people and talked to people or saw people I've already met before, the question was asked sort of what am I looking forward to today or what would be most helpful? And it's really, for me, what I'm most excited about is hearing the current issues that you're facing. We get to shine a spotlight on the agricultural markets that are central to the CFTC's mission. And the market activity that has happened in the recent months and years, but certainly the recent months that I've been here, really remind us that our core obligation is to promote the proper functioning of derivatives markets. And that's our job. So it's important that we do that well because agricultural markets and agricultural sector is really the lifeblood of our economy. I look at it as our nation's agricultural community is filled with true American heroes, hardworking families and small and medium-sized businesses who put tremendous effort into feeding us and clothing us and helping drive our economy. But I understand that these heroes face unprecedented circumstances. I mean, we started with the pandemic, and then, of course, the supply chain issues, the geopolitical events, the extreme price volatility, and the escalating impacts of climate change. I think just one of those challenges would be tough, but together, all at once, they can feel insurmountable. So now, more than ever, farmers, ranchers, and producers need derivatives markets to work well for hedging and price discovery. And I am very committed to making sure that markets are working well for them, that the markets are resilient, that they are transparent, and they have integrity. This summer, I had the wonderful opportunity to visit farmers and producers in Michigan and Arkansas. On the Arkansas trip, I had the distinct pleasure of visiting with, going around with Senator Bozeman and Commissioner Mersinger. And we had a blast, I will tell you. I very much appreciate Commissioner Mersinger's background, the way she grew up, her experience, her family, and I really benefit from that. On these trips, I did hear about difficult choices that are having to be made in the face of rising input costs and a lot of concern about extreme price volatility. So you can read about supply chain disruptions, but it takes on a much stronger meaning when a farmer is telling you that a part on the tractor broke and that they cannot get a replacement part in time for the harvest. Or I heard a grain producer who was telling me about how Train Company cut a major rail line that went down to New Orleans, and that the trains that are left do not show up on time. There are not enough truckers. I learned that grain producers then will have to store grain longer and may not be able to accept additional grain from a farmer who then may have to drive longer distances at the time when there was rising fuel costs. I talked to commodity traders who had become really deep experts on the impact of Russia's invasion of Ukraine, especially in the Black Sea blockade of the Ukraine grain ships. And what I heard universally was that margins are razor thin and that the continuing price fluctuations make the future uncertain. This uncertainty is compounded by severe climate events such as the drought that lowered water levels on the Mississippi River to historic lows, disrupting the passages of barges carrying corn, soybeans, and other crops downriver for export. On my ag tours, when I asked, first question I asked was, "How are you doing?" Farmers always answered in terms of inches of rain that week. This is probably something many of you are familiar with. So I want to hear from you about the challenges that you are facing and what you're doing to meet these challenges. I think the good news is that our American farmers and ranchers and producers are resilient. And during my ag tours, I heard about new technology developed to enhance efficiency and sustainability. So I went to the University of Arkansas and learned about the research they're doing in using drones to limit the use of fertilizer. So the drones would have thermal imaging on it. They would fly over a field to see the hot spots that needed fertilizer rather than the whole field. Very important at a time of rising input costs with fertilizer. I learned about research into microbiomes in livestock to help prevent disease. And this research and this use of technology has been fascinating. I learned about sustainability efforts to make the land more resilient to climate events. I learned about how distributed ledger technology, or blockchain, is used to trace individual livestock from birth and to limit food recalls to specific farms rather than, if you remember, we used to have like a recall of all romaine lettuce, which was a waste, a significant waste of food and dollars. And as the sponsor of the CFTC's Technology Advisory Committee, I'm really interested in understanding the applications of new and emerging technologies for our agricultural sector. So these are the types of initiatives that really reflect the ingenuity and resourcefulness of our American hero farmers, ranchers, and producers who are finding inventive, tech-forward ways to adapt to evolving conditions. So to support them during this time of challenge, the CFTC should always have top of mind how we can best ensure that the agricultural derivatives markets that they rely on are well functioning. In these times of razor-thin margins and high volatility, the CFTC must make it a priority to ensure that commodity markets reflect the legitimate forces of supply and demand. I can vividly recall being on the Crumbaugh family farm where Mr. Crumbaugh pointed right at me and told me he expected the CFTC to do its job to make sure that markets are free from manipulation and price distortion that could artificially raise prices. He was not the only one to tell me that. I came right back from my ag tours and recommended that the CFTC conduct deep dive studies into trading in key commodities that have experienced significant volatility, starting with wheat, oil, and natural gas. And we need to use the resources at our disposal, our authority, data, and expertise to fulfill this core responsibility. Conducting these studies could bring confidence to markets and market participants that our agricultural derivatives markets have integrity and they are not subject to manipulation or excess speculation. We owe this to the hardworking families and small and mid-sized businesses at the heart of our agricultural sector. These American heroes must never lose faith that their interests are central, truly fundamental to the CFTC's mandate. So thank you so much for coming here today, and I look forward to the discussions.
Thank you, Commissioner Goldsmith-Romero.
It is a pleasure to speak to you today for today's meeting of the Agricultural Advisory Committee. I thank committee sponsor Chairman Benham and designated federal officer Bridget Wiles for bringing everyone together to talk about these important issues. I also welcome the committee's new members and existing members. During my visits to our key international partners and markets trading hubs, I have made it a point to understand the United States' major agricultural exports and trade priorities. I've also learned about the significant challenges that commodity markets face in the aftermath of the pandemic, like labor shortages and shipping constraints. It reminds me more than ever that the United States is founded on an agricultural economy, and agriculture is still a major driver of our economy today. The Agricultural Advisory Committee holds special meaning for the Commission given its roots in a time when most futures trading took place in the agricultural sector. It's hard to believe that it's been over 150 years since boards of trade were formed for grain trading. Just like the United States, agriculture is where this agency began. It is where we come from, and it remains at the heart of our agency today. Today's program reflects how important agricultural derivatives remain to our market participants. Geopolitical and weather events continue to impact commodity market production and prices during a time of supply shocks and high inflation. The war in Ukraine, government sanctions, and droughts have affected agriculture in different ways that make output more difficult and expensive, including the cost of energy and production of fertilizer. Agricultural derivatives remain an important tool for our market participants in the face of these varied, dynamic uncertainties. Being able to hedge risks in deep and liquid markets has been and is a cornerstone of the CFTC's purpose. I look forward to the Agricultural Advisory Committee's work on how the CFTC can most effectively work and communicate with all of you in the agricultural community. As a commissioner, I wake up every day proud to serve you and the public. I want to share my gratitude with you all for your service by bringing your expertise and experience to these critical issues. Thank you.
Before we begin today's presentations, I just would like to remind everyone to be mindful of your microphone when it's muted and unmuted because we are recording this event. And also, we will have an opportunity for members of the committee to make comments or ask questions along with the commission after each presentation. And for the record, I'd also like to note now that we have all 35 members in attendance. Now for our first presentation, we will hear from Dr. Cynthia Nixon, the Deputy Chief Economist of the Office of Chief Economist at the USDA, for an update on the agricultural economy.
Thank you, Bridget. Chairman Benham, commissioners, thank you for having me here. I'm delighted to participate in the meetings today. And the Office of the Chief Economist is a small office within USDA, and within OCE sits the World Agricultural Outlook Board, which is responsible for producing the World Agricultural Supply and Demand estimates every month. We serve as a coordinating committee, and we're drawing on expertise across the department to produce this trusted source of information. I have a lot to talk about today, so let me just hop right into it. Okay, obviously, with farming being such a diverse sector, I can't talk about everything, so I use my title slide with lots of pictures to try and be a little bit more inclusive. Let me just jump right in. I'm going to talk today about the outlook, focusing on some of the major crops and livestock. In the Northern Hemisphere, harvest is largely wrapped up. So I'll talk about where we are with production for the year. I'll focus on some of the climate and weather-related issues that we're facing in the U.S. and some of the geopolitical risks that farmers are facing, and touch briefly on some of the tools farmers are using to address these risks. And I'll wrap up with some highlights from the farm income forecast that USDA released last week. Okay, this slide shows corn, soybean, and wheat production, giving you a trend to put the current year production in perspective. Corn ended up at 13.93 billion bushels in 2022. This is the 7th highest on record, down about 7.6% from last year's 15.07 billion on both area as well as yield. In the U.S., one of the factors contributing to these results were poor planting conditions at the beginning of the season and some warmer than average temperatures during July and August, contributing to a below trend yield. Areas have declined as well, and this has led to supplies falling to nearly the lowest in a decade. Soybean ended at 4.35 billion bushels in 2022, down from last year's record high, again due to declines on both area and yield. Wheat, 1.65 billion bushels, essentially flat, up just 0.2% from the previous year. Most of this is winter wheat. Production was down for winter wheat, largely due to drought conditions, but we did see some offset due to increases in other spring wheat and durum wheat. Of course, when Russia invaded Ukraine, there was huge concerns about global food security, lots of attention paid to U.S. wheat and supplies to the market. In 2022, wheat planted acreage was down, but what we've seen is that harvested acreage, especially for other spring wheat and durum wheat, was up, offsetting some of that decline for winter wheat. And drought conditions were the major factor contributing to these wheat production results, as you all know. Turning to where we are with the current winter wheat crop, this was NASA's crop condition index from last week. It's the last that they produced for the season. You can see the results for 2022, the red line at the bottom. Winter wheat's essentially gotten off to a pretty tough start this year, again due to drought on the plains. Now we have had some rain in the southern plains, snow in the northern plains, helping winter wheat, but this crop is going to need quite a bit of assistance over the winter and into the spring to increase production. Last week, about 40% of the crop was rated very poor to poor in 5 of the major producing states 2 weeks ago. And then last week, only in Kansas did that characterize conditions, so we are seeing some progress. For cotton, weather has cut crops in the United States. Drought is a major factor, especially in Texas. The U.S. planted acreage in 2022 is down, and planted area in 2023-2024 is expected to contract sharply to its lowest level since 2015-16. Weather is affecting not just U.S. production, but world production, as you know. In Pakistan, Australia, and Western Africa, rain's been the issue, but we've had improved weather conditions, largely accounting for larger crops in China, India, and Brazil. Rice production is down 13.7% from the prior year on both lower acreage and yields. Weather again plays a role here. Rice planted acreage in California in particular has declined about 50% over the past several years. That's due to lower water allocations. Turning now to the livestock side, this slide shows cattle inventories on the left, hog inventories on the right. The cattle market has natural cycles. That's a little bit evident in this slide with the peaks and valleys. And you can see right now we're coming off a recent peak. Among other factors, drought is playing a contribution to the downswing in the markets, as was mentioned in some of the remarks by the commissioners. Poor pasture conditions are resulting, and this is coupled with high feed costs that's causing early placements and decreases in breeding stock. For hogs, we're also seeing a pretty sharp decline in inventory. Some of that's a reflection of biological lags and some recovery from what happened during the pandemic. Higher feed costs are also clearly playing a role there. But we're also likely seeing some uncertainty with other factors over the last 12 months. So we'll see where we head up. And I'd like to just say at the outset, too, that these results are as of the November WASDE. You all know that we have the December WASDE being released on Friday. So I'm not previewing any of that. I'll leave that to our analysts. Okay, taking a look now at where we are with prices. This slide shows season average prices, so a lot of the intra-year volatility in prices gets a bit washed away in these numbers. But what this shows is, if you look at the far right column, it shows the percent change in prices, and essentially what we're seeing is strength across the board. Wheat in particular, for the 2022-2023 season average price, we're projecting that to reach a record $9.20 a bushel. Now, again, in November, this was prior to knowing the outcome of the UN grain, Black Sea Grain Initiative that was set to expire on the 19th. We know that's been extended. So we'll see what the projection is with the December WASI on Friday. But still, we've already heard, and everybody in this room is aware of the continued volatility in these markets. There's just a huge amount of uncertainty around the stability of that agreement, contributing to that volatility. Now, these high grain prices are obviously going to weigh on production of beef, pork, broilers, and turkeys. Looking at those prices, again, season average prices, these are for the calendar year. Looking into 22-23, with the exception of steer prices, prices are expected to decline across the board. But I would note that they're still well above the 2015 to 2019 average, as well as 2020 and 2021 for the most part. For steers, the tighter supplies are due to us being in the contractionary phase of the cycle. The forage issues that are pulling cattle forward into feedlots. So slaughter rates are higher now, and forecast is for some tightening into next year with continued high demand. For hogs, reduction in production this year is happening. Producers cut back on farrowing, small pig crops, supporting prices into 2022. So we're expecting, looking forward, for there to be larger farrowings and higher hog supplies that will put downward pressure on prices. Broilers, we're anticipating that the producers are working through some of the hatchability issues that have affected them this year, so increased egg sets. We've had relatively strong prices as well. We're expecting to see some increase in broiler production going into 2023, but we are expecting to be coming down off some of the high 2022 prices. So in terms of a trend in broiler production, it's been increasing slightly over the past few years, up 2.5% in 2022. But again, we expect prices to decline going into 2023. I'll just touch briefly on turkeys. We have tight supplies due in part to the HPAI outbreak that has affected that crop. Dairy cow inventories, relatively steady state, not dramatic increases in production this year. In 2022, the industry was declining, but we're expecting it to stabilize. Slight increase in average cow numbers, increase in milk per cow. And in the interest of time, I'm going to flip to the next slide here. There we go. We've been talking about the drought. This slide puts that drought in perspective. This is the U.S. Drought Monitor map, which USDA has helped support, and we've had access to this tool since around 2000. So in terms of the perspective, this year we're in our longest streak of widespread drought. Drought has covered more than 40% of the continental U.S. for 114 consecutive weeks, far exceeding the 21st century record that was previously established in the 2012-2013 period, when widespread drought lasted 68 weeks. So we're over 2 years into the current drought that's been this widespread. And I would also say this 40% threshold, we've been well above that lately, with about 59% of the continental US experiencing some level of drought in the last week. As you can see from this map, the darker red, the more intense the drought. Most of the intense drought has affected the western half of the Mississippi River Basin, although in recent months, that drought has been expanding eastward. Another factor is that we're entering our third straight La Nina winter, which has not happened in 20 years. And these weather patterns are affecting the drought in the West in particular. Topsoil moisture conditions are also declining. So the economic impacts of the drought matter significantly as to when the drought happens in terms of production cycles. This chart, the map on the left, shows corn areas in drought as of November 15th. And at that point, drought was affecting about 2/3 of the Corn Belt. But the thing here is that most of the drought didn't affect corn until late in the growing season. The chart on the right, the tan line at the top, is a summation of the drought categories, the share of corn area that's experiencing drought. And you can see relative to harvest that this significant share of corn areas in drought increased substantially after that point. So conditions were pretty good in the eastern Corn Belt, but dry in the west Corn Belt. So drought didn't affect corn production as much as other crops like wheat and cattle. And that's what this map shows. 73% of the cattle production areas were subject to drought this year. And the line chart on the right shows that there's just a lot more stability in the share of production area experiencing drought. So that those poor pasture and range conditions led to higher placements in feedlots, and those conditions are going to matter significantly going into winter, particularly with higher feed costs. We've heard comments already about drought and the Mississippi River levels. This map is a snapshot of where the basin boundaries are. The basin drains about 31 states in the US, and it's led to significant challenges for grain movements to export markets. So we've been tracking effects on basis, barge rates, pace in export shipments, as well as fertilizer movements back up the river. Let me see here. Seem to have lost my mouse. There we go. Okay, this map shows soybean basis movements, and I would note that the challenges that we faced with the Mississippi River low levels, we hit record lows in October, which was happening just as we were faced with a potential rail strike that led to some challenges for soybeans in particular, because the October-January window is when a significant share of soybeans are exported. This chart shows basis for the Gulf, which is in green, versus the interior markets, which are all the other colored lines. And typically at this time of year, inland soybean cash prices along the river carry a basis of minus 20 cents a bushel. And we can see here into June, July, and August, some strengthening of inland prices under the expectation of strong export demand. But since August, they sharply deteriorated. But we see a sharp rise in basis at the Gulf. What this translates into is about a $2 per bushel in interior basis swing, coinciding with surging barge rates. And in October, farmers looking to sell would have been getting $1 to $2 a bushel lower That's about 10% of the cash price than what they would have gotten without the disruption. And what we can see here is that the basis in the Gulf has been extremely strong. Of course, it always carries a premium relative to interior markets, given its more lucrative location. But typically, the Gulf basis hovers about 60 cents a bushel this time of year, plus 60. But this year, it surged to almost $2 to $3 a bushel. And that obviously is because not enough grain was moving down to the Gulf, and the weak basis in interior markets is indicative that rail and trucking options were just not good alternatives. So we are also tracking inland fertilizer prices and movements back up the Gulf. The Mississippi River issues are a particular challenge for fertilizers and other inputs. And in the case of fertilizers, about 25 to 40% of U.S. consumption of DAP and MAP goes through the Mississippi, and about a third of urea consumption. And these charts show the prices of fertilizers across different regions. The black line is the Gulf. Prices are cheaper at the Gulf because that's their import point, and prices get more expensive the further away from the Gulf, given the additional transportation costs. What we see here is that fertilizer prices in general, urea on the right and urea on the left, and DAP, MAP on the right, have been falling lately. This is due to softening demand, some easing of energy prices. Obviously, the prices further from the Gulf have been more expensive. What we see here, especially in the right chart, is Gulf prices in black have been falling a lot more, but inland prices are staying a bit flatter. And that's a reflection of the increased transportation costs. Let me turn now to some geopolitical risks. There are a number I could talk about. I'm going to focus on two. The first is the Russian invasion of Ukraine. As we've talked about, this is contributing to a lot of turbulence we're seeing in commodity markets, leading to concerns about fertilizer supplies. And of course, globally, a main concern here is food security. I'll also talk a bit about China and the lockdowns that are happening. Not necessarily a geopolitical risk at the outset, but whether we have drought in South America could lead to tightened global supplies. But I would just note that countries react to weather in different ways that could have global implications. India is an example. They had a devastating drought, and as a result, they restricted supplies of wheat and more recently rice, including broken rice, to the markets. And it's because of their enormous food assistance program and trying to protect food for their people. Okay, we've talked about volatility in the markets and what's been happening. A big question in commodity markets regarding Ukraine is really what's moving and what's not. And what this map shows is some of the intelligence that we're using to develop our estimates. This is a map that shows export routes, which are the arrows. And in yellow, throughout Ukraine are the grain silos with the size of the dot reflecting capacity. Prior to the UN grain deal, Ukraine was exporting 1.5 to 2 million metric tons monthly using these overland routes, which is about a third of normal. This chart shows Ukraine's top exports by commodity. Not surprisingly, exports are down for nearly every commodity. Corn and wheat, in terms of volume, are top exports. Corn is down over 10 million metric tons relative to the latest 5-year average. Russia and Ukraine together are accounting for a large share of wheat production. Ukraine, I would also note, is the 4th largest corn exporter. So these contractions in exports have big implications for global supplies and prices. Ukraine also contributes significantly to world exports of sunflower seed oil and meal. We also have concerns going into the next growing season for farmers in Ukraine. This chart shows export pace by month for calendar year 2022 for wheat and corn. The blue line is the average volume over the 2019 to 21 period, and the dark orange bars for January and February show the pace pre-war. The gray bars are exports by means other than the Black Sea corridor, but I would note we have data only through August at this point. And the yellow are exports via the Black Sea corridor. The point of this slide is clearly exports are off their normal pace, as we know. Also, some challenges not just with exports, but it's problems moving grain even before getting them to the ports. And when we think about geopolitical risks, it's helpful to think in terms of the shares of production that actually are exported. And that's what this map shows, is the share of U.S. ag production that's exported. Overall, about 20% is exported by crop, overall rather. Some of the crops are more dependent on exports than others. Cotton, wheat, soybeans, rice are principal field crops with high shares, cotton leading the way at 83%. We also see a number of high-value crops that are highly dependent on exports. And as economies of developing countries continue to grow, we expect the trend, there will be a trend for more diverse food options, and exports for these crops are likely to remain strong. So where are our exports going? This chart shows the progression over the last roughly 20 years. China is the top ag export market. The shares going to China has increased from 3% in 2001 to 19% in 2021. China is the top market for U.S. soybeans and cotton, and near the top for corn with Mexico. But China's corn exports are highly variable and subject to a TRQ, so that's limited quantities in recent years. This chart shows U.S. market share in China relative to our competitors. The dotted line represents the U.S. market share, and in terms of the area chart, the U.S. is in yellow. What this chart is showing is that U.S. market share has not fully recovered since the start of the trade war in 2018. In terms of some of our competitors, Brazil, which is the light green area at the bottom of this chart, is the biggest competitor to the U.S., followed by the EU, which is in purple. Now, China COVID restrictions have had an effect on demand, as we all know, and that's one of the biggest risks going forward. Especially with the recent lockdowns that they've imposed to try and control the spread of coronavirus. And if the economy falters due to these COVID policies and they continue to impose strict lockdowns or move back to strict lockdowns for any length of time, the expectation is that it will squeeze demand for a number of key commodities. And I would also note that China did have a major issue with African swine fever a couple years ago, and they're still in the process of rebuilding their herd. We're expecting that to generate new soybean demand. Stocks are low. We're also expecting to see China take maybe a wait-and-see approach with the South American crop, following what happens in Brazil. And if there are record crops in South America, China could buy from them, but if crops decline, subject to some of the drought conditions that could happen, especially with the La Nina conditions this year, that could mean stronger demand for U.S. products. Just a quick note on the various tools producers are using to manage risks. We have a number of USDA programs, crop insurance, farm safety net programs, lending and disaster programs, marketing contracts, different market mechanisms. Futures and options are used primarily by the larger corn and soy farms. Farmers are also using on-farm storage, which became critical during the low water levels on the Mississippi. Farmers were actually even looking to rent storage at that point. This slide shows trends in acreage enrolled in federal crop insurance. It's up over time, but you can see from this chart that it's largely flat for crops. About 60% of crop acres are insured. Pasture, rangeland, and forage index products started back in 2007. About 248 million acres are insured. Disaster program expenditures, we have some standing ag disaster assistance programs, but the point of this chart is just to show that these expenditures vary quite significantly over time. Now, just to give you some top-line forecast that was released last week. This is the forecast for the sector as a whole, the profit forecast. It suggests a very positive picture overall if this is realized. We can see that net cash farm income, the orange line, is expected to hit a record. But I will note that farmers are facing not just the high prices as we've been talking about, but high input costs. But taking the two together, the expectation is that there will be positive outcomes for the sector as a whole. I do just want to take a minute to unpack this a little bit because not all farms benefited equally. This slide shows average net cash farm income, the forecast for crop farm businesses. So this is including about the 50% of farms that where farmers either have stated that cropping is their main source of business. It excludes the smaller farms where production farming is not the main source of business. So looking at this 50% of farms, we see a bit of a mixed picture here. We see wheat is down a little bit, but corn, soybeans are up. Cotton and specialty crops are forecast down, as are other crops. On the livestock side, also a mixed picture. For cattle and calves, the forecast is for a 16% increase. Hogs down 11%, poultry businesses up 8%, and dairy up 64%, largely on high demand. And this final slide just wraps things up by just making the point that even though we have strength in the farm sector overall, there are still a substantial share of farms that don't have positive farm income. Residence farms, about half of residence farms, a little over half, are not forecast to have positive farm income. Intermediate farms, 51%, commercial farms, 13%. So really the strength in the farm sector is being driven by the 87% of commercial farms that are forecast to have positive farm income, as well as the 49% of intermediate farms. And with that, I'll conclude by just making a note that on Friday we do have the WASDE release. We are now broadcasting those briefings, so you're welcome to participate virtually or in person. We've had some groups coming in. And also registration for our Ag Outlook Forum is open. And we're delighted to announce that we are holding that in a hybrid format this year. So we hope to see many of you in person. And if you can't make it in person, hope to see you online. Thank you.
Thank you, Dr. Nickerson. We will now open the floor to discussion for members of the committee. If you are attending virtually, please raise your hand in the Zoom to be called upon. Do we have any questions or comments from the members in person?
I was just going to say, thank you very much. Appreciate the chairman and the commissioners. Excellent presentation. I think that net farm income study is very important, and I appreciate you unpacking that a little bit about what really happened there. And I apologize for being the last person to make it in person, but my phone rang at 7:28 this morning, and it was about drought and crop insurance and all of these things that are being covered. And that was 6:28 in Texas, where my crew was calling from. So I just want to say thank you. That was very helpful. I think that'll be a great presentation for people to see all around DC, and I really appreciate the commissioners. I know between a lot of other issues that you're dealing with, it is fantastic to see you all sitting here, really spending the time to see what affects all of us. And I don't care if it's your coffee or whatever else. I really appreciate the comments you all made, realizing how important this is. Thank you.
Thank you, Ryan. Do we have any more questions or remarks from anyone in person? Joe Barker?
If I may, I was a little confused by your data as it relates to dairy. You were showing dairy prices were down 10 to 16%, I believe, on your dairy slide. You were showing grain prices up, I believe, on your grain slide, but then you showed dairy income up dramatically. That data doesn't make sense to me.
We're looking into that, actually. I was surprised by the height of the bars, but dairy prices in 2022 were pretty strong.
Yes.
Across the board, and it's the strength in those prices that's outweighing. Yes,
So is it a marketing year issue? Is that the issue?
yes, that
Okay.
is part of the issue, yes.
So if you look at the marketing year going forward, we're looking at a very different situation.
That's
for the-
correct.
For the dairy farmer.
That
Okay.
is correct.
That's what I was wondering, if it
Yes.
was embedded in that data. Thank you.
Thank you for bringing the question out.
Thanks, Joe. We also have a question from Ed Gallagher, who's attending virtually. Ed, if you want to unmute your microphone.
Good morning, everyone. It's a pleasure to be here. I'm assuming you can hear me.
Yes.
Yes, okay. Dr. Nickerson, thank you for your excellent presentation. It's very thought-provoking, and I think the group of us could spend the rest of the day and into the afternoon just dissecting it and talking about our own sort of commodity businesses. So I represent the National Milk Producers Federation, and I work for Dairy Farmers of America, and I run their commodity risk management program. And so I've got a question about, have you and your team thought about, so I live in the future, right? So it's a great, it was a great presentation. I'm trying to take that and look into the future. And one of the challenges that I'm trying to think through is the impact on corn and soybean meal commodity prices as biofuel mandates increase, and there's growing greenfield and other production of soy plants, to crush plants. And I was curious if you'd thought much about that yet, and if you could help us think through a little bit about what that may mean going forward for feed prices and basis. Thank you.
Yeah, so farmers will be reacting to prices, obviously, when they're making their decisions. And we do expect demand to remain strong going forward. Obviously, EPA's decisions around renewable fuel standards will matter here too. I'd like to actually encourage you to come in Friday and join us with the WASD release and see what our analysts have to say. I had hoped to bring one of them with me here today, but it's a little too close to WASD to actually have them come and talk with you folks. So I would invite you to come on Friday to get a little more insights into that.
Fair enough. Thank you.
We now have a question from Michelle Mapes, who is attending virtually.
Thank you, Bridget, and thank you, Dr. Nickerson, for your excellent presentation and the information. With respect to Mr. Gallagher's comment, I work for Green Plains as the Chief Legal and Administration Officer, and I'm delighted to be on this committee, and thank you for that appointment. I simply wanted to pass along a comment with the RVOs, the renewable volume obligations coming out from APA just last week. What we saw as an industry in the ethanol renewable fuel industry was an effort to essentially, by reason of where the RVOs were being set, what looks like a dampening effect on renewable diesel at a limited level by the ERIN program that will be available for the electric vehicles, and therefore the RINs available for renewable diesel will flow into what's called a D6 RIN. And those prices should come down, therefore probably lowering the profit margins some of the RD producer. And to Mr. Gallagher's concern, that should be a welcome relief for those in the ag sector who have alternative uses for some of the co-products used in those functions. So just passing along what we are seeing as an industry, albeit ethanol continues to be a very challenging industry with many of the things you spoke of, Dr. Nickerson, with the rail pressures, the interior basis levels on corn being extremely high due to drought in the West in particular. Thank you.
Thank you, Michelle. We are running a little behind schedule, so now I would like to open it up to the chairman or the commissioners to see if there are any questions.
I know the time is short, but I do want to say that was a fantastic presentation. And I'm very glad that you address China with the COVID lockdowns. I just returned from Asia, and it's all I heard about. And I'm sort of very interested, and I know we don't have time to discuss this now, but whether the market is starting to price that uncertainty in the same way that the uncertainty related to Ukraine and Russia's invasion of Ukraine is being priced in. I know we don't have time to get into that, but I spent a lot of time over the last week in Asia talking to them about markets and the continuing COVID lockdown in China and how that is likely expected to continue and how that'll affect prices. So thank you, but thank you on all of this. This was really great.
Well, to that, I'll just say cotton, textile demand in particular, is going to potentially see a lot more volatility due to those policies.
I just want to say thanks so much, Dr. Nickerson. That was tremendously interesting. One tiny piece of information that I'll look for maybe covered in WASD, or if you have time later during one of the breaks. But I'm just thoughtful about the data you shared regarding where production is and export is with respect to Ukraine. I think you mentioned that your data closed out in August, and we've seen sort of some significant number of events in that region since that time. Again, acknowledging the limitations of time here, and if you want to offer a word or two, that'd be great, but I'm happy to also find you during one of the breaks and just hear what your estimations or reflections might be on what would be the quarter since your data closed out.
Yeah, the overland routes are where we were lacking data up through November. And it's a little hard to say what that situation is without actually seeing the data.
Thank you to the commissioners for their comments. I think now we will move to our second panel to keep on schedule, and we will hear from Scott Herndon, the president of Field to Market, on a holistic view of how the value agricultural chain works together on sustainability issues.
Thank you all very much. It's an honor to be with you here this morning as one of the newest members of the Agricultural Advisory Committee. I'm in the hot seat immediately, but I appreciate the opportunity. Chairman Benham, Commissioner Johnson, Commissioner Goldsmith-Romero, and Commissioner Mersinger, and Bridget, thank you so much for helping me design this presentation today. So again, my name is Scott Herndon. I'm the president of Field to Market, the Alliance for Sustainable Agriculture. So to kick it off today, I'd like to provide a general overview of Field to Market and who we are. So our membership is split into 5 distinct sectors. Each of these sectors has a voice in shaping our programs and governance. The grower sector is comprised of national level commodity groups, including several members of the AAC here today. This includes Cotton Inc., the National Corn Growers Association, and more, as well as a handful of state-level organizations. The affiliate sector is comprised of public sector partners, including many major land grant universities. This includes, universities, Cotton Trust Protocol, USDA, NRCS, and some media groups like Trust in Food. Our civil society sector includes the Nature Conservancy, the World Wildlife Fund, and working lands groups like Ducks Unlimited. Our agribusiness sector is our largest sector, and it's defined broadly as any company that provides a tool or service to farmers. And that includes aggregators, processors like ADM, Bunge, Cargill, seed and input companies like Bayer or Nutrien, equipment manufacturers like John Deere, and smaller ag and startup companies like Sound Agriculture or SIBO. And last but certainly not least, our brands and retail sector includes retailers like Target and Walmart, as well as major brands like PepsiCo and Unilever. Across our membership, each sector has balanced representation and engagement so that the full agricultural value chain is involved in shaping the work of our organization. So this is my favorite slide in any presentation. This shows who our members are, and it's pretty overwhelming because there are a lot of folks there. This is the entire agricultural value chain, and everybody, we don't have everyone, but we've got a lot of folks here. And I won't spend time calling out each member, but Field to Market was formed first as a working group of interested stakeholders, bringing together a handful of grower organizations, brands, agribusinesses, and environmental groups to think about how we could collectively align and advance sustainability as an industry. Put simply, we were born out of the belief that no one organization can meet the challenges our industry faces alone. For over 15 years, we've grown to represent nearly 170 member organizations, and we've become our own standalone nonprofit. However, our vision to unite the full value chain has stayed the same. We currently have 168 member organizations, uniting in our mission to meet the growing demand for food, feed, fiber, and fuel in a sustainable and responsible way. And I might add that this year alone, we've added 27 new member organizations. So the interest in sustainability is it's very high. So together, our membership is united to balance the two parts of our vision by supporting a resilient ecosystem and enhancing farmer livelihoods. Now, I've told you about who we are, but now I'll dive into what we do. So Field to Market's programs and tools are focused on building a bridge between our credible science and our members' sustainability goals. I won't read this definition, but I'll leave it up here for a minute for you all to read. This is our definition of sustainable agriculture. There are many definitions of sustainable agriculture, but this is one that has been bought into by our large and diverse membership. And we define sustainability as meeting the needs of the present while improving the ability of our future generations to meet their own needs, and then with some additional detail behind that. And then we took about a year to develop a definition of regenerative agriculture. And there was a little bit of push and pull, but ultimately we came up with this definition here on the board, and that is supported by principles. And we found that this gave a lot of folks comfort because it's broad enough and flexible enough to accommodate different areas and different local needs. And so what makes Field to Market unique is that our approach is quantitative, grounded in science, as our metrics are science-based. We prioritize outcomes-based approach, and we're not a checklist of practices. And we never tell farmers how to farm. We say that we're technology neutral so that we have no preference whether a farmer's management is conventional, organic, or anything in between. Rather, we meet farmers where they are and in the value chain and help them find opportunities for continuous improvement. So we currently have 11 commodity crops represented in our programs, and we plan to add some new crops such as pulses, flax, and oats. And the list evolves over time, but these are basically the major commodities by acreage in the United States. And this is the crux of what we do. We have 8 sustainability metrics that are tracked in our program. Each of them undergoes a review process by our member-led metrics committee every 3 years as new science is available, such as our biodiversity metric, which was only added in 2019. And biodiversity measures the capacity of a farm to support habitat for plants and animals. This could look at things like flooded rice fields that support migrating waterfowl, or edge of field areas that allow for wildlife to form habitat. Energy use calculates all energy used in the production of one crop in 1 year, from pre-planting activities to the first point of sale. This means that it considers the embedded energy used to produce seed, fertilizer, and chemicals applied to the field. And greenhouse gas emissions calculates the total greenhouse gas emissions from 4 main sources: energy use, nitrous oxide emissions from soils, methane emissions from flooded fields, and emissions from residue burning. Irrigated water use uses a simple equation to account for the amount of water used to achieve an increase in crop yield. Land use looks at productivity by accounting for how much land is used to produce a crop. Soil conservation measures soil loss to erosion from water and wind, which is shown to a farmer as tons of soil lost per acre. Soil carbon uses a USDA NRCS tool, the Soil Conditioning Index, to analyze whether a field is gaining or losing carbon. We also incorporate the Comet Planner tool as an optional feature. Comet Planner provides farmers with an estimate of the potential amount of carbon that could be stored in their soils following a practice change. And finally, water quality provides a detailed assessment of the risk of nutrient loss in local waterways and shows how well practices are mitigating that risk. Now, how do we measure the sustainability metrics? We measure them through our FieldPrint platform, which provides farmers with a field-level assessment of how their management practices affect our 8 metrics. The platform benefits the entire agricultural value chain, from the farm gate to the retail and restaurant counter. The FieldPrint platform is available online for free. It's confidential, and any farmer can log in to use it at any time. You can also log in as a guest to test some hypotheses and play around with it. And I'd like to highlight the chart on here. This is what we call our spidergram, and this shows benchmarks. So the blue is the farmer, the individual farmer, and the green is the state benchmark, and the orange is the national benchmark, which we get from USDA data. We publish a national indicators report every 5 years that's based on the USDA Ag Census and other USDA surveys. And so it provides a farmer with a lot of different information so they can have a project benchmark, so they can just know where they stand compared to their peers. In addition to our FieldPrint platform, we also offer an API service where members can integrate our sustainability metrics into their own tools. We currently have 8 API partners, which we call Qualified Data Management Partners. If a project is using one of these tools you see on the slide, then they have access to our metrics, as well as their own special capabilities. The idea is that wherever farmers are already turning for their agronomic insights, they can now see sustainability analyses in the same tool. Now I'd like to dive into our Continuous Improvement Accelerator project framework. This is the other side of what we do, like it's the actual projects. So our members are able to measure and track impacts through our program framework called the Continuous Improvement Accelerator, which allows member organizations to implement locally led conservation projects. Here, our member organizations come together in pre-competitive collaborations to support farmers across the country in adopting sustainability practices. To give our member organizations room for flexibility, depending on their goals and needs, we offer 3 different project pathways. Incubation projects are the projects that don't have to use the FieldPrint platform and focus on educating growers on at least one particular natural resource concern, which can be to improve water quality or soil carbon or habitat. Here, for example, an agribusiness company could work with 100 farmers to increase understanding of soil carbon improvement by supporting them to complete soil testing and analysis. Insight projects are really measurement projects, where annual data entered year over year into the FieldPrint platform is used to benchmark progress against environmental goals. Here, for example, an ag tech provider could support 50 participating farmers in demonstrating sustainability performance through the FieldPrint platform, capturing the impact on sustainability and bringing agronomic advice and value to the clientele. Innovation projects are where our members are providing in-depth technical or financial assistance to help farmers reduce the risk associated with trying new practices. So, for example, we have some projects cost sharing for cover crop seeds, and we have other state grower organizations focused on supporting farmers through in-depth technical assistance. Here's a map that shows all our active projects, and to date we have 66 active projects across 37 states, and in 2021 we had growers enrolled in 4.6 million acres in locally led projects. And projects can range from, there's no limit or there's no parameter for project sizes, but currently our smallest project is 300 acres and our largest project is 1.3 million acres. And within those 66 active projects, there are about 100 different organizations participating. In addition to supporting members in the implementation of projects, we also want to make sure that our members can tell the story of their project from year to year. From participation claims to impact claims, projects can transparently communicate about their progress and achievements at different stages in their efforts to improve environmental outcomes. That might be demonstrating that the company supports a large number of farmers and acres in learning about sustainability. It may be that they've successfully increased the adoption of practices like no-till or cover crops. Or it may be collecting several years of data to tell a story of sustained environmental improvements. And a lot of our members are implementing projects through Field to Market to reduce greenhouse gas indirect emissions. And I'd like to run you through where we fit in the process of Scope 3 inventories. They use the Greenhouse Gas Protocol to measure and account for their Scope 3 emissions. As you may know, the Greenhouse Gas Protocol land sector removal draft guidance has been released recently for pilot testing and explains how companies should account for and report greenhouse gas emissions and removals from land-based activities in their inventories. Following that, some of them set up a science-based target to play their part in helping keep global warming at or below 2 degrees Celsius. The FLAG SBTI explains how companies can set science-based targets to reduce land-based emissions. They report and disclose their reduction target using different voluntary reporting frameworks, and this is where we fit in. We can help them reduce their emissions and reach their science-based targets, and this cycle is repeated annually. I'd like to provide you with some specific member examples. In September, ADM and PepsiCo, 2 long-standing Field to Market members, announced a groundbreaking 7.5-year strategic agreement to collaborate on projects that aim to significantly expand regenerative agriculture across their shared North American supply chains. This strategic partnership is expected to reach up to 2 million acres by 2030. Both entities will be using Field to Market to track their efforts and goals. This agreement and the projects within it will initially enroll corn, soy, wheat, and wheat farmers across Kansas, Minnesota, Iowa, Illinois, Indiana, and Nebraska to increase visibility across the supply chain and integrate a range of multi-year farmer-first regenerative agriculture initiatives, including cover crops, reduced tillage, nutrient management, diverse rotations, and responsible pesticide use. Reaching the strategic partnerships goals could eliminate 1.4 million metric tons of greenhouse gases, equivalent to the amount of electricity used to power 275,000 homes per year at the farm level, while creating meaningful shared value directly to farmers. However, this groundbreaking agreement isn't the beginning of the ADM and PepsiCo partnership. To date, ADM and PepsiCo have worked together on 25 projects registered within Field to Market's Continuous Improvement Accelerator. You can see that these projects range in their geography. Projects have focused on corn, wheat, and/or soybean, and have been tracking a variety of field to market metrics, including greenhouse gas emissions, irrigation, water use, land use, soil carbon, water quality, and soil conservation. For the past 2 years, ADM and PepsiCo worked together on various projects, has awarded them and their additional partners the title of Collaboration of the Year. Just a few weeks ago, Field to Market announced that our 2022 Collaboration of the Year was supporting Nebraska farmers to boost resiliency via cover cropping projects. This project honored ADM and PepsiCo, as well as Practical Farmers of Iowa and Keurig Dr. Pepper, for their work to advance corn and soybean sustainability in Nebraska. Farmers Business Network has joined this partnership in 2022. Enrolled in Field to Market's Continuous Improvement Accelerator, this project has united cross-sector organizations and competitors to continuously improve productivity, profitability, and environmental outcomes for farmers through direct contribution of funds to provide technical assistance to growers and subsidize cover crop seed. The project provides a cost share on up to 200 acres for the adoption of a soil health practice. In 2021, the project's first year, 38 farmers enrolled in the project, planting over 15,800 acres of cover crops, surpassing the goal the partners set in 2021. Beyond improving environmental outcomes, this year's Collaboration of the Year also focuses on achieving behavioral change among farmers, showcasing the environmental and economic benefits of soil health practices to encourage practice adoption and maintenance. Farmers enrolled in the project are given a membership to Practical Farmers of Iowa, allowing them to access the peer-to-peer learning opportunities PFI provides. Upon joining, each farmer is also given a welcome call from another farmer who has experience with cover crops. These efforts help to build a peer network for farmers within the project, hopefully removing some of the isolation some producers may feel when trying a new or different practice compared to their neighbor. Opportunities exist within the program to attend cover crop and soil health field days and workshops. Each participant can also develop cover crop plans with PFI cover crop agronomic experts. Another project ADM and PepsiCo have been working on together is the ADM and Illinois Corn Growers Association Corn Illinois Project. Registered as an innovation project, ADM, PepsiCo, and the Illinois Corn Growers Association are using a cost share mechanism to increase the adoption of cover crops. This mechanism provides cost share funding for new cover crops and nitrogen per acre. Another Field to Market, Mondelez, has been tracking sustainability through a number of projects in our FieldPrint platform. I'd like to share a little bit more about one of their projects. This one, operating in Michigan, is titled the Mondelez Michigan Wheat Project. Registered as an insight project in our accelerator, this project aims to support participating farmers in understanding the greenhouse gas emission impacts of their current management decisions through use of the FieldPrint platform, incentivize the adoption of nutrient management and soil health practices that reduce greenhouse gas emissions. Project data generated is given to a third-party sustainability consultant to help with data analysis. The Field to Market data is used to generate supplier-specific emissions factors. Mondelez is working with Co-op Elevator, who provides agronomist expertise and helps with data entry and sharing with growers, and Michigan State University, who assists with grower outreach on this project. In 2021, there were about 150 growers involved in this project who enrolled approximately 30,000 acres, and 2022's numbers look similar. The winter wheat sources through this project is utilized for Mondelez's Triscuit crackers. Shifting gears, I'd like to finish out by talking about Field of Market's work in the innovative finance space. Field of Market spent a lot of time over the last few years working with experts across our membership to uncover some of the key barriers to scaling sustainable and climate-smart practices. In 2022, we partnered with Trust in Food to conduct a survey of more than 500 farmers across the nation within their network. And farmers understand the long-term benefit of conservation practices, but the short-term risks of productivity and profitability often create barriers to adoption. I'd like to dig into a little bit of that right now. So what we found was that 62% of farmers believe that implementing conservation practices improves their long-term profitability, and 74% of farmers believe that they should receive monetary incentives for adopting certain practices that benefit the public good. Nearly all respondents indicated they are currently implementing to some extent or have tried at least one conservation practice. Where farmers see value, they are not seeing a return on that value, unfortunately. Only 15% of farmers in the survey have received better market access or additional revenue due to implementing conservation practices. That study drove the point home for Field of Market and our members that we must all share in the risk and reward of sustainable agriculture. And it laid the groundwork for Field of Market's work in innovative finance, showing that there is a growing attention on the financial barriers to adoption. There are growing questions about how financial innovation can overcome these barriers. There's a need for targeted solutions to address key farmer barriers, and there's an opportunity to map out some innovative finance mechanisms to target and solve key challenges. Throughout 2021, Field of Market formed an innovative finance working group and worked to identify some of these financial strategies to help producers overcome barriers to adoption. In that report, created from the Innovative Finance Work Group, we provided 12 key blueprints for companies across the supply chain to explore as they consider how to harness different financial mechanisms to support farmers. It shares concrete strategies for overcoming key barriers to farmer adoption of conservation practices, moving beyond early adopters, and addressing the agronomic and financial risk farmers face in transitioning to these practices necessary for a more resilient agricultural system. Since the publishing of that report, the work group has now become a full standing committee within Field of Market so that they can continue this valuable work. The Innovative Finance Work Group examined solutions and blueprints in 5 areas: blended finance, sustainable finance, transition risk sharing, and land tenure and leasing incentives. Each of the 12 blueprints created falls into one of these categories. The report concluded with 3 key recommendations to guide the action and implementation plans of companies interested in harnessing innovative financial incentives to accelerate sustainable outcomes. Those were to engage existing financial partners throughout the value chain in discussions about sustainability, experiment and pilot innovative financial mechanisms and diversified incentive strategies tailored to address farmer needs, challenges, and motivations, and finally, share the results to spur adoption and innovation across the industry. Be sure to check out the full report on our website. Tied to that report is Field of Market's Partnerships for Climate Smart Commodities USDA grants. We were awarded with a funding ceiling of up to $70 million. Our proposal was built off our innovative finance report. Our project will center around the Climate Smart Agriculture Innovative Finance Initiative, which will use innovative finance mechanisms to accelerate climate smart practice uptake by farmers, leveraging private sector demand to strengthen markets for climate smart commodities. While we've had our initial meeting with USDA, there are several details we are still working through, and we look forward to sharing more information about the final projects in the coming weeks. This project will cover more than 30 states and reach over 10 commodities. The project will use innovative finance mechanisms to accelerate climate smart practice uptake by farmers, leveraging private sector demand to strengthen markets for climate smart commodities. Partners will provide technical assistance and additional financial incentives to a diverse array of producers across the commodities, tying climate smart practices to commodity purchases and creating a scalable model for private sector investment. A portion of the awarded funds will specifically support Black and Native producers, assisting underserved producers in adopting climate smart practices. In addition to our own lead project, we were named as a major partner in 5 other projects, with the National Association of Conservation Districts as one, ADM as another, National Sorghum Producers as another, USA Rice as another, and Wolf's Neck Center as the final one. In closing, I'd just like to say that no one sector can do it alone. It's going to take each of us to reinvest and reinvigorate our work into understanding the barriers and opportunities, because there's a lot of opportunity here facing agriculture as we seek to shape a more resilient, equitable, and sustainable future. We must work across the supply chain to achieve necessary outcomes, and Field to Market is the right organization at the right time to lead the value chain toward sustainability. And before taking questions, I'd like to turn to Robbie Boone to talk about our USDA program.
Well, thank you, Scott. And what was echoed earlier, I want to thank the commission, the chairman, and all the commissioners for taking time, particularly in the midst of everything else going on. Just your dedication to the commission's agricultural roots is much appreciated. With respect to Field to Market, just wanted to add that Farm Credit Council was very pleased to join Field to Market earlier this year. We're participating in the Innovative Finance Committee. As many of you know, Farm Credit has been providing for the credit needs of rural communities and agriculture for over a century, with over $360 billion in gross loans. We are excited about this work related to climate smart commodities, particularly the grants and C, as we are partnering with our local institutions just to better understand the intersection of farm profitability, environmental impact, sustainability. We're excited to see how this plays out over the next year.
Thank you, Scott and Robbie. Let's go to members in person. Are there any questions?
I have one question. On the finance side of it, because I'm the other half of the equation here from the Farm Credit guys, have you started talking to lenders about how they're changing underwriting practices and some of the things they are looking at? Because from the banking side of the world, some of our larger institutions are really looking at, do we change our underwriting to better reflect sustainability and things that are happening, especially across the ESG space, right? So just curious if you've reached out, or I guess the second part, how can I be a resource to help you reach out to some of those institutions?
Yeah, so thank you, Ed. I'd like to turn it back to you. Like we've started initial discussions, and in developing recommendations for our innovative finance report, we certainly took input from financial lenders. But I think that there's a fear from farmers. They want it to be an incentive, not a mandatory angle. And so that's something that we want to hold true to. And that's the feedback I've gotten.
I'll say from our end too, we don't want it to be a mandatory thing either. We want it to be one thing that happens a lot in the banking industry is there's a separation between agricultural underwriting and commercial underwriting, right? So I think part of it is connecting with groups like yours to make sure that our agricultural underwriters understand the dynamics that go into some of this stuff. So just love to find ways to connect. And then I will say from where we stand, we've been working with EDF a lot on some of this too. So I think there's some things we're already working on that will line up very nicely with what you're doing as well.
Yeah, absolutely. EDF was instrumental in our innovative finance report. So probably a lot of the input that you provided made it in our report. But I look forward to collaborating with you directly going forward. Yeah.
Let's now turn to our virtual participants. We have a question from Hayden Wands.
Yeah, so I'm representing the American Bakers Association, so I appreciate your comments, Scott. Just a question. Obviously, a lot of our members are, looking at regenerative agriculture, and I guess it's really a two-part question I have for you is, does Field to Market, are you going to be coming out, or do you have a definition of what you feel qualifies as a RA acre? In other words, if they have, if a producer is has instilled these farming practices, once they've instilled these farming practices, they can say that the production on that acre, is produced using regenerative agricultural practices. And I guess, do you have a definition, or are you going to have a definition of what Field to Market feels is a qualified RA acre?
Yeah, thank you for the question, Hayden. Yeah, so this I think we're giving this to members to define. They could come up and say that something is a regenerative acre based on this definition, and we are currently operationalizing the definition, if that's even a word, into our metrics. But it's not too dissimilar from sustainable agriculture, but there was a need and a demand for us to adopt a regenerative ag definition. But yeah, it's flexible. It's principles, but yeah. So I think we couldn't say today that, but I think it's something we're looking at. It's a good question.
And the second follow-up question, and thank you. It's so you're in the same boat that we are. The second question: do you think we've had the USDA come in and define what an organic acre is, or what an organic agricultural product is? Do you feel that is going to be the way regenerative agriculture is going to go, or do you have a sense that it's going to be more like the non-GMO project, where it's more of a private-based enterprise that the industry adopts as the, quote unquote, seal of approval for RA, like they did for non-GMO?
Yeah, so I don't, nothing would lead me to believe at this point that USDA is going to adopt a regenerative agriculture definition, but that might be a better question for Dr. Nickerson.
Or perhaps my colleague Aaron, but
Okay.
Don't have any comment at the time on that one.
Hey, I will say that, it's still, our definition is new, and we tried to get something that would be supported by our 168 members, so that it's got widespread support and lots of push and pull developing it. So I think it's, folks have comfort that our definition is a good workable one, but certainly if USDA wanted to adopt a definition, we would help them with that process for sure.
Thanks,
Okay,
Scott.
thank you very much. Yeah.
I'm going to now turn it over to the chairman and the commissioners to see if there's any questions.
I have a couple of questions. I'll try to consolidate them for the sake of time. But I'm always interested in the way that calculation for the carbon output of the soil. Is that calculated based on the soil when it's not planted and not producing, or how do you bring in the carbon kind of absorption that comes with planted acres into that soil, and what really goes into that data?
That's a great question. Thank you, Commissioner Mercier. Ours is all modeling, so we're not doing any soil testing. And just yesterday alone, we conducted a webinar for our members that was run by PepsiCo and ADM, describing how they would measure their reductions in greenhouse gas inventories. So that's not directly soil carbon, that's more emissions. But basically they would have a control field, a field that wasn't adopting any of the cover cropping or reduced tillage, and they would set that as a control. And then they would have the field with the intervention, and then they would measure the difference between the two. And that would allow them to come up with a measurement. But we are using NRCS's soil conditioning index for our soil carbon metric. So we haven't created our own at this point. We're using USDA's, and I think that's important because Comet Planner is being utilized throughout the USDA partnerships for climate smart commodities. So the USDA models are the baseline for all of the money out there, and some of that we're supplementing with our own individual metrics.
Thank you. That's really helpful. The other thing I was interested in, when you talk about some of the innovative finance, and that some of this has to do with you're looking at leases and those setups for family farms. And I hadn't really thought about this until we were in Arkansas and we met with their legal agriculture team at the university there, and they had mentioned about how they are trying to reach out to a lot of family farms and offer legal advice, because there are folks in the industry who are coming forward with land leases and contracts that are not, one, just not favorable to the farmers, but two, also don't recognize the difficulties that some of these farms face when they go into a situation where there's estate planning, or when the head of the family passes away, and suddenly the farm is now divided between numerous siblings. And so just wondering if you all are working on that and talking to farmers and offering any help on looking at some of these leasing and tenure options that are being put forward for some of the carbon capture projects that are starting up.
Yes, thank you very much for the question. And I'm an attorney, so I certainly appreciate the value of contracts and a well-written contract, and certainly a contract that is reviewed by your own personal counsel. I would always recommend that anybody who's going to sign a land tenure or leasing incentive review that with their own counsel. But we were part of a group called the Climate Markets Collaborative, which adopted a framework, and one of the key issues was transparency of contracts. Because I've heard similar stories, and there's certainly a fear about farmers potentially not knowing what they're signing up for. So our farmers share the same concern, and so we have been active in the Climate Markets Collaborative, and you could look online and look at what they've outlined. We helped with that, and it calls for transparency. Yeah.
Thank you.
Thank you, Commissioner Mercier, and thank you, Scott, again. We're going to now take a short 10-minute break. It is 10:59 for the record. Let's get started again. And now for our third presentation, we will hear from Tim Andreessen from the CME Group, the Managing Director of their agricultural products, on evolving price limits in the ag markets.
Commissioners, Mr. Chairman, and the committee, we appreciate the opportunity to be here today. We really appreciate the opportunity to be part of this committee. Historically, we have been sitting at this chair on frequent opportunities talking to the committee and haven't been a part, and we appreciate having a voice in the committee in a way that we haven't in the past. I've been around the agricultural markets for a really long time, about 40 years, and as long as I can remember, markets have had price limits. In many, many years of those limits were determined by member committees. This is back when commodity exchanges were mutualized organizations. They would get together on some reason and decide to change the price limits. When I joined in 2009, I really couldn't understand what the logic was behind that, but it was simply the way that the exchange operated. Shortly thereafter, myself and our team of economists got together and said there really needs to be a different way to think about price limits and to make decisions around price limits. The challenge that we have with price limits is that on one hand, we have to have price discovery. And we want to have markets that discover price, particularly in times when markets have extreme moves. When markets are moving extremely, price discovery and the ability to execute in those marketplaces is very, very important. On the other hand, we have a lot of customers and a lot of concerns about markets that move significantly and the impact, particularly on the smaller player in the marketplace. A smaller market participant typically may not be as well capitalized when markets start to move significantly, and here we're talking about smaller commercials, producers, folks like that. Markets start to move significantly, they have to talk to their banker, make sure that they have the ability to maintain credit lines to meet margins. So we're constantly trying to find a balance in between of how do we ensure both of those things take place? How do we ensure that price limits can at least slow down significant moves in the marketplace, but at the same time, we continue to maintain price discovery. The other thing we felt it was really important for us to do is to create clarity of process. It's really difficult as a trader to say, here's where I am, here's what's going on, here's what I expect tomorrow, and then all of a sudden the exchange comes along and says, guess what, you have a new price limit. And that was the environment that we lived in for quite some time. So we went about trying to develop a process that would allow us to have a clear mechanism and a clear approach to price limits. And beyond that, one that had some sort of mathematical basis to it. So we took the approach of what we call variable price limits. We've been phasing these into our markets since 2012 in the agricultural markets or in the grain markets, and most recently, a few years ago, in the livestock markets. The idea is quantitative in that we believe that you're going to have limit movements in the marketplace. That's just the nature of markets. But you should have, or at least target, some mathematical number of limit moves. There's no right answer to this question. What is the right number of limit moves, or how tight should the bands be? But the approach we've taken, we said, look, if we have 1 out of 100 sessions where we hit limits, 2 to 3 days a year, that's probably reasonable. It continues to allow the market to move, but we're going to have events pretty much every year that probably warrant hitting a price limit. So we took the approach of saying, let's see if we can solve so that 1 out of 100 days, mathematically, we would hit a limit. We recognize that markets aren't normal. You don't have a standard distribution. You don't even have log normal distribution. You have crazy distributions like we've seen in this year, where that isn't going to work. You're not going to have one price limit move in 100 days. You're going to have 4 or 5 when you have something significant happen in the marketplace. So we recognize that it's not always going to work as nicely as you could mathematically model it. Second thing we said is, when we're looking at volatility, it needs to be relative to the price. So, 25% volatility on a $2.50 corn is a whole lot different than 25% volatility on $10 corn. Mathematically, it's just simply 4 times as much. So the price limit needs to be tied to the price of the underlying, so that as the price of the underlying goes up and down, the price limit also expands and contracts. We know that happens over time. We had a lot of discussions as to whether it should change every day. And we finally settled on the idea that about twice a year we should look at the price of the underlying, figure out what it is, apply a percentage to that, and come up with a price limit that would be the band for the next 6 months. We could do it more frequently, we could do it less frequently. In fact, in lumber, we do it daily, but for the most part, the feedback we got from customers was twice a year, particularly with grains looking, in the spring where we can get some forward look as to what we would expect the crop to be, and in the fall where we have a general sense of what the harvest is going to be, would be reasonable windows to look at the price. So we put in place this concept of variable price limits. In the case of grains, that's 7%. So twice a year, we'll look at the underlying price of grain. We'll calculate a limit based on 7% of that price. There will be some rounding numbers to make sure that it's a nice round number. You don't want a price limit that's 37.5 cents or something like that. So there's some rules in play, and then we'll publish those price limits. That process worked particularly well, and we still believe it works particularly well. But this year we had obviously some levels of volatility in the marketplace that we had never anticipated before. And what I wanted to do is take a couple minutes and actually walk you through what we saw in the marketplace and our thought process around that in terms of price limits, and also why we decided to make a change in price limits. I want to emphasize that what I can tell you about is from the business side. Clearly, while all things are going on, there's a very significant amount of communication with CME, with the clearinghouse, not between us, but with the clearinghouse looking at these things and looking at margins. And margins are completely calculated independent of the business. The clearinghouse does not communicate with the business of CME about what margins should be. Their whole goal is to place margins and set margins at a level that ensures the integrity of the clearinghouse and the clearing process. Secondarily, market reg. Market reg and the business talk a little bit, but essentially market reg is, I believe, always having a conversation around the CFTC around issues, and that is, again, independent of the conversations we were having. Predominantly, where we're engaged is through my team and through our team of economists engaging with the CFTC, and in the case of this, it was with Crystal Lockmeyer, who I know is no longer with the CFTC. So let's see if we can switch over to Tableau. It's just going to take a second here. So there's a lot on here. Let me kind of explain to you what you're looking at. So there's two contracts here. We have the top three sections are May wheat. The bottom three sections are July wheat. The blue represents price, and each line of blue is 1 day. The red represents bids and asks, depth of the book, and the purple represents trade on a minute-by-minute basis. So what we're looking at here is this is the week of the invasion. The Monday, Tuesday I cut off. There's nothing exciting happening. Wednesday, you could see the market start to anticipate the invasion happening. Prices rallied. The book was fairly orderly throughout that, and we saw volumes. I'd also like to point out that this is the whole trading day. So this is from the evening through the close the next day. So if you look at this section of this line, that typically represents the day trade as opposed to what's happening overnight. This is the day of the invasion. And you can see that very early in that day, as a matter of fact, at 10:35, these are all Central Time, the market went limit. And the market stayed limit throughout the night. The bid, one of the things we look at is how deep is the bid at limit. So we saw at this point in time, we literally had 66,000 contracts bid at limit. When we look at how well the market is discovering price, there's a couple things, or handling limits, there's a couple things we look at. Number one, we look at trade. Even when the market is at limit, it will occasionally trade at limit, or it'll come off at limit and trade. Number two, we look at spread trade. If you're a trader and a market is limit, one of the ways you can execute is that you can go back to one of the back months, execute in the back month, and then trade a spread against the front month. So effectively, you're still being able to hedge in the front month, but you have to go a little bit more complicated to get there. The third thing we look at is we look at the synthetics. So you can look at an option, you can look at a deep in the money option and look at the futures price it's implying, and that tells you what the market is suggesting that the market should be trading at if the futures were trading. So those are three things that we're constantly looking at when we start to get into a limit condition to see if, what we need to do or what's going on with the marketplace. So as we look at that day, we saw a pool of about 66,000 develop. When the day session came along, we started to see trade. We didn't see near as much a pool in the July contract, and again, we saw a good amount of trade. Typically, if you look at the pattern of trade on the exchange, you'll see a lot of trade near the open, you'll see a lot of trade near the close, and you'll see trade during the course of the day. So, clearly what was going on was on our radar screen as to, this is not a normal market condition. We need to be looking at what's happening. The Friday was, quite frankly, not a particularly remarkable day. We didn't see limits. We saw the market trade lower. So I think the market started to digest what was going on and decided that, maybe there wasn't as much here to see as they thought. Starting with Monday the next day, so this is actually starting Sunday night the next day. That Monday was a pretty non-eventful day. Tuesday, you'll note, we started to trade up higher, and toward the end of the day, Tuesday, we started to hit limits again. And we hit limit significantly on the nearby contract, on the May contract. We did see a little bit of trade, not much, and then we also started to see pools build in the July contract, 32,000 bid. So what we're starting to see is we're starting to see, in our mind, wait a minute, maybe there is more of a response in the marketplace to what's going on than the last 2 days have shown. If you move on to Wednesday, you can see that again, overnight we traded, we hit limits again, and during the day we hit limits in a very significant way with, an even bigger pool building, about 160,000 contracts. Same thing in the May. What we were also seeing as this took place is we're starting to see the synthetic options implying a price that's significantly higher than where the futures price was showing. So about Wednesday or so, we were meeting on a pretty regular basis saying, what's going to happen here? This is clearly an unprecedented event. It's clearly having a significant market impact. What, if anything, do we need to do? We then went into Thursday. Again, we saw, hang on a second here. We saw overnight hit limits. Thursday afternoon, we saw, again, significant limits with significant pools. We're 173,000 contracts bid. And we also continue to see a big build. There's another 50,000 there. At that point in time, we decided that, looking at how our limits had been working, how our markets were working, that we probably needed to figure out a way to create more expansion in our limits. Now, normally for us to change our limit scheme, it's a 45-day process. We come up with what we want to do, we submit it to the CFTC, 45 days later they say yes or no. I want to give the most amazing kudos to the CFTC because Friday night and then Friday morning, we opened up limit on both of these contracts. As you can see, there was virtually no trade in both of the contracts, and we had significant pools. We had up to 200,000 bid there. We had up to 50,000 bid there. Friday morning, we engaged with CFTC and said, look, we need to change the limit structure. We think the market is not discovering price the way we would like it to. And here's our proposal. Now, coming to that, we had gotten a lot of feedback from customers. And I will tell you, the feedback is in completely different directions. we had a lot of customers saying, you just simply need to take all the limits off the market. We are, particularly some of the financial participants, were saying, from an ISDA standpoint, we're having market disruption events. We can't settle products. We can't settle indexes that we're running. We need price discovery. On the other end, we had smaller participants saying, these limits are too tight, you need to tighten the market up. Okay, we can't, we're having to go to a banker virtually every day to get more money to try to be able to meet our margin calls. And there was a lot of people sort of in the middle who were saying, look, the market's working, but it probably needs a little bit more breathing space. We're always trying to, listen to all of those and weigh across those different interests, what should we do? At the same time, I might also point out that the clearinghouse, independent of any action we're taking, had significantly increased margins. So I think margins were at, about a day and a half's worth of moves. So, we got to the point where Friday morning we engaged with the CFTC and we said, we want to change the limit structure. Again, this is a 45-day process. On Saturday, they approved it. So I will tell you that, when things need to move, things move. And I really appreciate that because I think how that happened was pretty phenomenal. So Sunday night, we went into the marketplace with expanded limits, with expanded beyond what we typically would have had expanded. On Sunday and Monday, we continued to see the market hit limits, but we saw the synthetics come in significantly. We saw a significant amount more of spread trade in the marketplace. And we saw, pools only in the nearby and no pools in the next contract. And we definitely saw trade in the next contract. So we're feeling much more comfortable. On Tuesday of that week, as you can see, we went back to a situation where we had definitely two-sided trade in the marketplace. We didn't have pools build. We saw good volume as people were trying to catch up in terms of risk management. And interestingly, on the following Wednesday, we saw a fairly tight range, and then we saw the market go limit down. So, the market was still, again, trying to adjust for and digest what it was hearing in the marketplace relative to what's going on in the Ukrainian situation. From that point forward, there weren't any really significant limit events in multiples like that. If I can switch back to the other presentation. So what we did and in that movement and what we then kind of codified and cleaned up and are looking to do in all of our products is based on a couple learnings we had. And we also had a similar situation in lumber earlier in the year too, where we saw lumber. The whole idea of variable price limits hinges upon the value of the asset. Lumber, we saw the value of the asset go from $600 to $1,300. So if you think of a percent, if your limit is 10% of $600 and you go to $1,300, it has functionally become 4 and some percent of that. In the case of wheat, we saw a 40% increase. So essentially our 7% limit became a 4% limit. So we said we need to think of a way to allow the market to adapt to a situation where we have a significant move in the underlying. So the other thing that we found is that the way the limit rules worked is it was very easy to retract and snap back to original limits, but we wanted to be able to, within the rules, maintain expanded limits for a longer period of time so that we would have the ability to discover price. So we've made some changes, and these are changes we would expect to implement across all of our agricultural products. Historically, there was a situation where we would have to have 2 contract months hit limit and stay at limit before we would expand to the expanded limits. And now it's only 1 contract month. In terms of the expanded limits, it used to be that if to remain in effect on the next business day, one has to settle at least initial to the limit price. So in other words, if the limit was $5, it would have to settle at $5. So it couldn't be anything less than an expanded limit. Now we've changed that so that if it's anything above the original limit, it continues to stay expanded. And third, we've implemented a mechanism that says if you have the market where it hits expanded limits 2 days in a row, then we further expand that and make that the base limit. And I'll walk you through an example of what that would look like. So if on day one, the limit was 50 cents, the expanded limit was 75 cents, and the price was $5, then on day two, if the market went to 550, it would have hit the 50-cent regular limit. And because of that, because it is a limit move, it would expand to 75 cents. On day two, let's say that the market went to 625. So it went up 75 cents, hit the expanded limit. The limit would continue to be expanded on day four. Let's say it went to $7, hit the 75-cent limit. Now what would happen is the limit structure itself would change to where the base limit becomes 75 cents and the expanded limit becomes $1.12. So essentially, and this process can continue as long as the market moves. We went back historically, this would have happened maybe twice in the last 20 years. So this isn't something that we expect is going to happen very often. But you know, as you're all aware, when those tail events happen in the market is when you need things to be predictable and you need things to work. And so that's why we have taken this approach. So right now, if you look at the limit structure we have in place, you know, we have the base. We still have a base 7% limit for most of the grains. Cattle is 4.25%. Hogs are 4.5%. Lumber is in a completely different mode. So the expansion goes to plus 50%. So currently limits are corn is 45 cents and 70. Wait a minute. 45 cents and 70. Beans are $1, $1.50. Wheat 65 to $1. Meal is 30 to 45. Oil is 4.5 to 7. Cattle is 5 3/4 to 8.5. Hogs are 4 3/4 to 7. Now I got to tell you, as somebody that's been around a long time, these look big, and particularly producers look at these limits and say that's a really big limit. But again, you know, the approach we've taken is with where the underlying prices are, and mathematically, we think that these are the right limits to get the right outcome in the marketplace. That's all I really had to cover, but I'm certainly happy to take questions.
Do we have any questions from the members in person? Yep, Liam Smith.
Sure. Liam Smith from the FIA Principal Traders Group. Really appreciate the commission chair and the other commissioners for setting this up and allowing us to participate in this event. And Tim, good to see you. I think one thing on this is that we wanted to talk about is, you're right, it's a really tough dynamic of managing both those price limits, and what happened during the Russian aggression is something that had a very positive outcome, but it relied on, as you said, extraordinary action. So I think a few questions in there would be, one, what is the game plan going forward for those extraordinary action? Is it going to be the same process? Is there any change to that? Because it did work out, but again, over a weekend, as an example. And then a few other pieces of questions there. Why did we settle, just curious, on the biannual look back would be one, versus like a more quarterly process?
Yeah.
And then last piece, a lot of the other commodity sets have added something like velocity logic or kind of level 2 market mechanisms to help with this exact, like moving too fast, too quick, giving the market a breather but not closing it down. I'd be curious to hear, you know, that exists in, again, say, energy and metals, et cetera. Just curious why, you know, I don't believe that's in ags just yet, but curious to hear your thoughts on that.
Well, that covers pretty much everything right there. So going forward, we are changing all of our other commodities to the model that we have in wheat. So literally, you will know that if you get two expanded limits, that the limit structure will reset. So instead of counting on us to do that, you know that, hey, listen, it's, you know, I'm sitting here at limit on day 2. Tomorrow the limit's going to be, you know, that's going to be the base limit, and it has the ability to expand further from that. We don't like being in a place where market participants have to guess about what we're going to do. We want to be in a place where you have 100% certainty that if this occurs, then this is how the limit scheme is going to be changed. Why twice a year? That's a really good question. We could do it more frequently, and we've had a lot of discussion. There's literally been discussion as should we change the limit every single day. And I think the consensus has been, and it's been very much driven particularly by some of the smaller customers that, listen, it's really hard to keep track of where limits are. I get you need to change it, but can we keep that to a reasonably small number of times? And so, in grains in particular, we looked at, well, where does it make sense to change? Historically, where do we see the changes in prices? And by looking at, so the window that we use in the beginning of the year incorporates the crop planting report, and it incorporates a lot of information that should tell you, hey, this is what we think the price is going to do going forward. So we think that price is reasonably informed. The price in the fall is based on harvest, so we think that price is reasonably informed. We're not locked down to twice a year. We're happy to look at other intervals. The third question, we do actually have velocity logic. It tripped in this cases, but the velocity logic doesn't really do that. If you're looking at things like circuit breakers, that is something that we would certainly think about. We think in general, the approach with circuit breakers would be to put circuit breakers in place so that we're stopping the market for a period of time. If it moves, stopping the market again. But ultimately, even if it's at a fairly significant amount, we'd probably want to have some sort of limit scheme in place, just because we do have a strong view and a strong desire to make sure that the small market participants eventually have something that stops it for the day and lets them go, talk to their banker or do whatever they need to. So.
Thanks for that question, Liam. We have a question now from a virtual participant, Justin Tupper. You have the floor.
Thank you. Appreciate that. Appreciate the chairman for convening this meeting and apologize for not being able to be there in person. My question to Tim would be, do you think that the market limits are causing some issues for convergence? For example, into the live cattle markets today, we see a board at 151 and actual trade in the 157 range. So because of the expanded limits, do you see problems that allows the board to be quite a ways apart and then converge hard at the end of a month? Curious what your thoughts are.
So with contracts, as you get into the delivery period, the rules change. So what you don't want is a situation where the limits prevent the market from converging. So as a matter of fact, when you get to literally the last day of convergence, there are no limits. So that it does allow that to do that. We don't, for the most part, limits are not affecting things in the delivery period. For the most part, limits are affecting things well out of the delivery period. So we don't think that limits actually have a significant impact when it comes to, convergence in the marketplace.
We are short on time, so let's move over to the chairman and the commissioners to see if we have any questions. Commissioner Johnson?
Thanks so much, Bridget. So I want to thank Mr. Justin Tupper and Mr. Liam Smith for their questions. They were my questions, in fact. I think the smartest question I would have been able to come up with was about convergence. So thanks so much for that, and Tim, for your response. But I also want to just sort of elevate the conversation, sort of back to a point you made earlier, Tim, on circuit breakers, not necessarily focusing specifically there, but on the broader question of macroeconomic conditions that are unique in that there's this sustained and persistent volatility that has led to some significant pressure. A number from this community have been in this room in conversation with myself, the chair, and other commissioners to talk about how that's affected them and their ability to meet margins. And so I'm just thoughtful as we think about what isn't sort of a moment of shock, a momentary shock, right? Sort of that March 2020 moment, but what really has come to be our new normal. If there are thoughts about addressing sort of this sustained set of macroeconomic conditions that seems to be so persistent that it isn't an outlier?
That's a good question. I mean, as long as we have high prices, unfortunately, we're going to have high margins. It's just it's a natural fact. If you, and I'm not the clearinghouse, so they could answer this question with much more detail and skill than I could. But if you look at what drives the margin, it's two things. It's the absolute price and it's the volatility. And it was interesting because as a lot of this went on, the clearinghouse would have a briefing with the rest of the business and would look at and say, well, look, this is, the fact of the matter is margins are up in a significant way simply because the underlying asset's up. And I don't think people appreciate how much the implications of that are on the marketplace. Case in point, we definitely see a lot of people participate less in the market at higher prices. Some people because of margins. Some people, if you're for example, if you're an index player, you think in terms of dollars of exposure. Hey, I've got $1 million exposure to corn. That used to be 40 contracts. Now it's 25 contracts. So you're seeing a lot of participation. A lot of the prop community, they're really good at framing the market and trading the market. But their approach gets really difficult when you have geopolitical events and the shock movements in the marketplace. So not surprisingly, they'll step back when that happens. So I don't really have any good answers as to how to address that. I think eventually one of two things happens: either we get back to a lower volatility environment, or this just simply becomes the new normal and people start to adapt to it. And for a big part of my life, corn was $2.50, and that kind of ages me. But it's definitely a different world that we live in now.
Thanks, Commissioner Johnson. Do we have any more questions from the commissioners? Commissioner Mersinger?
I have a question I hope it's simple to answer, but when you have contracts where there's a lot of kind of interconnectedness, like if you're looking at the soybean complex, do you consider those contracts, are they always considered individually, or do you look at the entire kind of complex when you're trying to set those limits?
That's a good question. Meal and oil are tied to beans. Feeder cattle and live cattle are tied together for that reason, because there is a spread relationship, and you don't want to have, if you have one of the legs limit, then what you end up with is the spread getting out of shape for a while and creating some margin implications, because you may have the cattle spread on, then all of a sudden one leg, if it gets way out of whack, you end up getting margin because one of your legs on that spread can't move with it. So yes, we do look at those things.
Thank you, Commissioner Mersinger. We don't have any other questions from the commissioners. Thank you, Tim. We will now move to our fourth panel, our fourth presentation for the day. We will hear from Jessica Steffen and Tom Erickson regarding the domestic and international shipping, freight, and storage impacts on the grain trade. Tom Erickson is outside counsel for NEGA and with Erickson Law and Consulting, and Jessica Steffen is the chair of the National Grain and Feed Association Waterborne Commerce Committee.
Hi, everybody. Again, my name is Jessica Stefan. I just want to thank the commission and the committee for having us here today to talk about something that has been in the news a lot lately. I work for a company, Bunge North America. I'm a logistics director. So today I do represent the 1,000 members of National Grain and Feed Association as chair of the Waterborne Commerce Committee, who have been battling some of these low water and trading market conditions alongside economy. So with that, I just wanted to talk a little bit about who NGFA is. It's a very vital member-driven organization. It's been around for a long time. We're a nonprofit trade organization, and we represent thousands of companies, over 7,500 facilities amongst the various country elevators, feed mills, exporters, commission brokers, banks, transportation, insurance industries within agriculture. The focus of the member-driven organization is to enhance and grow the economic performance of U.S. agriculture. And we do that in a number of ways. And one of the ways is really to engage with membership, such as myself, where we serve on committees assisting the association in their grassroots campaign, their education campaign, however we can service our membership on key industry issues or providing our subject matter expertise. America's waterway system is super crucial, obviously, to the economy. We've talked a lot about that today, and I'm going to go in detail of, again, what makes that the case, as well as what were some of the more detailed issues that we were battling this year. Because it does really kind of tie into what Tom's going to talk about later about the impact of trade, as well as tie back to a lot of the previous presentations today. As we've said several times, the waterway system across the United States is about 12,000 miles. So we always think of the major rivers, obviously, and I'll talk most specifically about the Mississippi River. But the inland waterway system is very important. Most of it is connected, and is there's a lot of tributary rivers that go into the larger rivers that are more of the navigation critical ones across 28 states. Annually, this system moves over 500 million tons, and the value of those commodities, again, this is on an average, so this year the value would be significantly higher, obviously, as we've talked about, is on average $130 billion a year. The river provides a lot to the economy in regards to jobs and moves, as we've said, 60% of Americans' grain exports, mostly out of the Gulf of Mexico. It is by far, and I'll talk a little bit about this, the most cost-effective, safe, and efficient and sustainable mode of transportation. I'll also cover some of the risks to that and all of us trying to meet some of those sustainability and ESG initiatives. Keying in on the Mississippi River, again, this is what's known as in the industry America's Water Highway. It's the path of the darker blue line in the map. It spans a little over 2,300 miles, starts in Lake Itasca up in Minnesota and drains into the Gulf of Mexico, in New Orleans. It's a very important trade corridor for energies, ags, and tons of other raw and manufactured goods specific to different industries, cement, a lot of building supply materials, and rock salt for the winter months. It's one of the largest rivers in the world, and as discussed in the first slide, the basin stretches between the Appalachian and the Rocky Mountain ranges. And this part of the region, is responsible for over 92% of the total ag products that are grown. So the drought is important for crop production, but the drought is also important for the transportation of all of these products. It's important to note that the Army Corps of Engineers oversees and has regulatory jurisdiction over the river, its levees and its locks and dams, and is in charge to maintain the channel depth, which is 9 foot deep and 300 foot wide for this entire region of the Mississippi River. This is probably one of my favorite slides, and there's different versions of this, but I think this, from our friends at the Waterways Council, really drives home the economies of scale. When we talk about how vital these three modes of transportation are to agriculture, and when one or all of them is experiencing issues, just how significant that can be felt on the various ends of the supply chain. Again, one of my favorite examples is one 15 barge tow, which is the amount of barges that a towboat can push north of St. Louis, is only a quarter mile long. That's equivalent to 2 of the 108 car trains, so 216 rail cars, which is almost 3 miles long. And then more astounding, another stat that I just love is 1,050 equivalent semi-trucks. So that's 15 miles long. So if you take the thousands of tows that transit materials up and down the river every year, and all of a sudden the waterways became not viable, can you imagine the amount of congestion we would have on the rail and on the highways today? And this is why. The waterway network is fairly simple. It's vertical, it's not complicated. It's been standardized for hundreds of years since the Corps of Engineers was tasked back in the early 1800s with creating a safe and efficient navigable waterway. It's become the sustainable and the lowest carbon way to transport goods up and down the river, as well as the commodities that are grown in the basin. Again, it's pretty self-sufficient. You can see from kind of the heat mapping index where the bulk of the tons come from feeding into the river. Quite differently, as of 2020, from the Department of Transportation, this is a map of the rail network. So if you think back to the simplicity of the waterway map, this is one that is definitely has a lot more complexities, not just to the agriculture sector, but also the energy sector. Or the railroad, excuse me, along with the waterways, these are old modes of transportation. Again, starting in around 1800s when we were looking at ways to make the river more navigable, rail lines were working with government on some of the charters to develop, more efficient ways to service industry. One thing to note about the rail industry of itself is that the hubs, and you can kind of see the color concentrations throughout the United States, but rail was designed around the services and the industries that where they were located. So it's not always as viable to switch between, say, waterways and rail, or vice versa, when one of them or both of them has their issues, because the rail doesn't go everywhere. And along with the major class 6 class 1 railroads, there's lots of other smaller regional players that service this network. And again, it's not as easy to take grain or any type of other commodity off the river and throw it on a rail car. And something that I'm sure that most everybody feels if you've driven on a road, which I'm sure everybody in the room has, the average daily truck traffic. There was a study done back in 2022 highlighting, again, this very horizontal mode of transportation. The highway department, started designing the highways from, coast to coast versus the waterway obviously is more of a vertical mode of transportation. So there's a lot of complexities. This is an expansive network full of, many, national highways as well as smaller rural roads. And you can definitely see where the concentrations are, and it matches up with some of the higher concentration, living areas across the United States. And just to reflect back on my favorite slide of the economies of scale, one barge tow of 15 barges is the equivalent of 1,050 trucks. So if we, again, had to replace the thousands of barge tows that are on the river today and offload them or put them onto trucks to get them to their final destination, I can't imagine what this map would look like. So changing gears a little bit and, looking at this both from somebody that is, managing a business through it, but also somebody that's very interested in the long-term sustainable, future state of the waterways. Here are some of the major concerns. Again, we focus in on the here and now of droughts and floods that create supply chain disruptions. And those are the ones that usually catch, press and a lot of attention because they're the here and now. But, for many years, the industry, including the members of National Grain and Feed Association, have been working to make sure that, organizations like the CFTC and other parts of the government know that the waterways has had a track record of being underinvested, and that's no news. So, one ask after today is if you hear the terms WRDA or NESP, you stop, take a look, and figure out what they're talking about, because those are some of the major congressional bills and legislation that we watch closely that funds the waterways today. Lock and dam maintenance, again, we talk a lot about the environmental impacts to floods and droughts, but the same can be said if we have long delays at locks or closures because of a breakdown. And we've talked a lot about dredging this year. I challenge everyone in the room to research this more, but there's very much a limited capacity when it comes to dredging. There's been a lot of studies from the Army Corps of Engineers and several other agencies that have shown that it's challenging to get ample budget and capacity to dredge the river and keep it at that 9-foot depth and 300-foot width, in a normal year, let alone when, some of the emergency situations arise and we need to, deploy those dredges away from port facilities to, unstrand tows that are stuck. I have to mention, too, that along the same lines, we've seen just dramatic infrastructure booms in China and South America, as well as the Chinese government investing in other regions to try to make their modes of transportation match ours. This is one thing that I'll touch on here in this slide. Again, there's a lot going on here, but this is a study from our friends at the Ag Marketing Service, the USDA, and it was put out in 2019, and I think it's very telling. Anytime that I'm asked to, go to the Hill and lobby for the waterways, this is one that I always either have or speak to, because this drives home the importance of the river, not just from an infrastructure funding, but also from a navigability perspective. The landed cost, and this was, again, back in 2018 is when the study was commissioned, but it's the first of its kind, and then there hasn't been an update since, but it still drives the message home. The Mato Grosso, Brazil landed costs into China. So the cost on the axis on the left is going to represent the landed cost of soybeans in Shanghai, China, and that cost at the time was $402.80 per ton, and the cost of beans coming out of Davenport, Iowa was significantly less. And then what the study did was look at, okay, if we just keep up with the status quo of funding for infrastructure, and then we maybe increase the funding or we decrease the funding, what does that do to the transportation costs, which are the other parts of the bar, and what does that do to farm value? I think the biggest takeaway, again, that we can look at from an economy is that if we do not have a efficient running waterway, whether that's due to lack of infrastructure funding or, again, droughts, the landed cost from that will likely be higher than what it will be in Brazil. So, if you look at it by 2045 and 2050, with the pace that Brazil is investing in the Amazon River, that's a huge concern for anybody to take back to their teams to figure out how we continue to allow our farmers and other people in this sector to have access to the export market without losing market share to Brazil. So again, switching gears more to the here and now, what happens when the river cannot facilitate barge movements? It's that growing issue, and we kind of talk about it. As Tim was talking with the CME presentation, I was thinking about this the same. You have a small blurb, you have a supply chain disruption, it creates some market fluctuation. Those happen all the time. It could be something small, it could be a geopolitical event, but that happens. But what happens when there's compounding impacts? Sometimes you have an inability to execute trades, which is going to impact that price discovery that we've been talking about. As transportation costs increase, that is going to drastically impact both the value to the producer and the cost that the consumers are paying all over the system. And what that can do, and has the potential to do, and we've started seeing it, is limiting market access and reducing those trading opportunities. So to kind of sum up, again, from a river perspective, but it also touches the previous presentations, what led to some of this on the river, and what was really driving the issues. We can talk about the below average rainfall, of course, with the lack of precipitation in the river basin, which restricted the depth and the width. We know there's been continued challenges with COVID-19 and the Great Resignation and all of the global issues related to the Black Sea and various supply chain imbalances and the energy crisis. And that has created what we've been talking about is a very uncertain market. We've also are in a very inflationary period. People are having trouble with financing, and the cost of capital is definitely increased from years ago. And so that's pushing users and everyone to run very hand-to-mouth inventories. So when you have disruptions in this type of marketing situation, the impacts are felt a little harder because the market has been telling you to run hand-to-mouth, but when you do, and then all of a sudden that market access is gone, that's really what drives some of the volatility that we've seen with the river. I think going back and comparing, I say lack of U.S. production issues, and it's not to discount that, yes, we've had droughts across the growing regions as illustrated by the USDA. However, when you compare that to the last significant drought issue with the river in 2012, the production was not nearly as impacted as it was in 2012. So you still had a supply push at harvest time, which was also when the river started experiencing the drought issues and the low water. We also had, going into Q4 of this year, demand at or above average, as mentioned previously. So more specifics to what some of the river operators and other people that are reliant upon river transportation were watching closely and continue to watch closely today are river draft reductions. Just of note, again, and it's hard to put it in perspective, but when you can't load a barge to the maximum depth, that means you need more barges to transit the same amount of grain. So when barges are in tight supply, again, that goes in that compounding impact. And what we saw at the late summer, early fall, when we really were seeing the low river, is a 25 to 30% reduction in the depth that a barge could be loaded. And again, that was due to the river being low and not having enough water in it for the barge to float down. Of note, in those regions, some significant areas for river transportation are St. Louis and the Mississippi and Ohio River confluence, which is in around Cairo, Illinois. And, having those areas as bottlenecks really create issues for the upper Mississippi parts of the industry, as well as the Ohio River, which then starts impacting, as mentioned, auto, mechanical, because a lot of the supplies are moving up the Ohio and down the Ohio on barge. At the same time that we had drafts reduced where barges couldn't be loaded as deep as normal and because of the river level, because of the width of the river was also constricted, towing capacity was reduced. And in some places that was a 40 to 50% reduction in the amount of barges that could be moved northbound and southbound. And this is significant because, again, it's going to take more line boats to move the same amount of barges, but what was also happening at the same time is that some of the larger horsepower line boats that are moving these barge tows were also offline because they drafted too deep. This amounted to a lot of river closures. There were several during the month of September and October, where at multiple periods of time there were multiple closures where tows ran aground, and those dredges had to be deployed in an emergency situation to clear the sediment to allow the tows to pass. That resulted in hundreds of tows and barges stuck, both going northbound and southbound, so it was just at a complete standstill. And that backed up into the entire chain from all the way to the farm field, because in this time period where farmers are, running a mix of what needs to go to market and what needs to go to my own personal storage, if a river shipper doesn't have access to an empty barge to load the grain, that really does impact what the farmer can do with that overflow grain. Another significant issue that's going to be touched on a little bit by Tom here is that loaded barges were not able to be transited. So barges that were loaded were stuck inland for over 60 days. And again, as an exporter, this is a significant issue. It really makes you think twice about making a new sale. It really makes you think twice about what you feel like you can execute and how much money you're willing to risk for demurrage because you have a lot of uncertainty of when those barges are going to be able to be picked up. As mentioned previously, dredging was a concern. There's not enough capacity for a normal program. And thanks to, again, some of the emergency funding released to the Corps of Engineers, but it's still something that we continue to monitor and that's going on today. So again, some of the impacts have already been discussed, but more specifically, and we'll get into these details, is, this is what happens, again, to that cash basis. So the price the farmer's getting. Barge freight during this time traded at all-time highs, really due to lack of equipment to load those newly harvested bushels. Along the same times as mentioned previously, there were threats of the nationwide rail shutdown, and of course we know that there's an ongoing shortage of trucks. So the other modes of transportation, while it's hard to flip between river, rail, and truck, those modes were not available as well. Again, speaking about the port facilities specifically and our members that are exporters, the capacity was reduced simply because of lack of supply. Mechanically, they were able to load ships and get product to end users around the globe, but physically we couldn't because of the supply delays. This had a drastic impact to customers, again, on all sides of the supply chain, from domestic to international consumers as well as the farmers, because of delays or inability to, receive commodities because of lack of transportation. The farmers did struggle to access markets, for this time, and that is a big concern, as we've discussed, for them, especially at harvest. And then along with the market impacts, we've had a lot of environmental. And something that I've not seen in my 15 years in managing logistics is what they've called saltwater intrusion. This posed a huge threat to the city of New Orleans due to the low river levels on the Mississippi, allowing saltwater from the Gulf to infiltrate. And this meant that the Army Corps of Engineers not only had to worry about the navigability of the inland river, but also had to work with the Coast Guard and other contractors to build what they called a saltwater sill to try and limit some of that saltwater from coming in and impacting the drinking water. Of course, as we all know, with drought comes drastic impacts to the river ecosystems and wildlife. So that goes unsaid. And again, teeing up Tom to talk a little bit more about the market impacts, a few slides from our friends at the Ag Marketing Service who put out a weekly grain transportation report. I encourage everyone to either subscribe or tune into that periodically, because it does show a lot of really great data and graphics to show some of the cyclical patterns. And the chart on the left is a good one. So this is your northbound empty barge transit up the Mississippi River just north of St. Louis, on the Arkansas River, as well as on the Ohio River up to go in. So this would be empty barges available to be reloaded with something. You can see there towards the end of September and October that availability was significantly less than last year's time. And again, this is what drove a lot of that basis moves, as well as you can see the chart on the right. This is Illinois River barge freight rates. So this is the value that barge lines were having to charge in order to try to get a barge in place. And you can see, looking at it from a rolling 12-month towards the left of the chart, that represents a more normal time frame during the same, harvest cycle, which I would say, last year there was a significant, more business versus the same time this year where there was an inavailability of the equipment. And then just of note, again, to kind of further drive this home, we were doing this calc on a daily basis, but 1 ton of soybeans from St. Louis, Missouri to New Orleans during this time cost right around $80 a ton, which is 400% more than 2021. And it actually reached a high of $105 in mid-October. And I'll leave you with a few really sad pictures of the state of the river. I'm sure the news and the press did a very good job covering this, but the traffic jam on the river. You can see the ones to the middle and the right. That's what a river traffic jam looks like, and you can see how tows are still trying to transit between some of those really silted-in regions, and that's just, again, in a normal year, those would be covered with water and available to have twice that many barges on. I'm going to kick it over to Tom.
Thanks, Jessica. I am Tom Erickson, and today I'm here in the capacity as outside counsel and advisor to the North American Export Grain Association. It's a pleasure to be back. Jessica has done a terrific job in giving us all the foundational information about the struggles on the river system, but also really about the value of the river system to the U.S. economy, and in particular, the agricultural economy in the United States. So we'll now transition a little bit from the inland waterway system and its value domestically to really kind of the why, and that really is the export market and the flow. The reality is that the river system, the Mississippi River system, does feed ultimately the export market, which the ports in the Gulf take about 50% or more of U.S. export capacity. Briefly, I just want to take a moment just to introduce the NAGA and its membership. NAGA is the trade association representing exporters in North America. You can see the companies that it represents. It represents also those that serve and support the export market and industry, and those are all shown here. If we can, one of the things that is often forgotten is that the agricultural commodities, agri-bulk commodities, are in fact part of the fungible supply domestically. So exports, whether commodities of corn or soybeans are going into domestic or export, it's all the same fungible commodity. This chart just illustrates those decision points in terms of where the commodities go in terms of the actual infrastructure. So one of these, this is a graphic. I know it's a little hard probably to see, but the river system is really powered by exports and export demand. Couple of things that are, I think, key for the conversation today, is this recognition that the river system is in fact basically flushing the agri-bulk commodities into the demand locations in New Orleans. The other key about the river system is that because of its vibrancy and its commercial activity, it is the delivery mechanism for the futures markets in soybeans and corn. And so when you have issues, and I'm sure, Tim, you're well aware that when you get into delivery months and these kinds of events occur, which they do, it is an issue directly related to the performance of futures. So with that chart there, the one back, sorry, the graphic there was showing effectively broker indications on CIF transactions out of the Port of New Orleans. And the top line there you can see is 2022. Those numbers have come down in the last week or so, but what they're showing is that the actual prices of commodities for international customers was increasing significantly, and it's one of those indicators where the river is saying we cannot take any more. And so it's a discipline in the market in terms of recognizing the difficulties and the disruptions in the underlying transportation on the river itself. Turning to the next slide, we look at two graphics, and again, they tell kind of the same story. And Jessica had showed us earlier a little bit about barge freight rates, and this graph demonstrates that same indication in terms of what barge freight rates did this fall on the top red line on the left chart. Those two have fallen off in the last week or so, but this is reflective of the lack of availability of barges, whether they were stranded or otherwise not in position or unable really to transit the river in that period of time. And again, it's a signal that the river can't take anything. In this case, it's not just drought related. It is related to river levels and the availability of the barges on any given day. The right-hand chart is indicative of the corresponding in time effect on basis at river locations. Which is, again, you see the bottom blue line with the steep drop in basis relationships, which is the market's mechanism, again, of telling producers that the system can't take any deliveries, and in part because there's a lack of an availability of barges, and the barge freight rates are saying that. And then you on the slide before, saw the direct relationship with the prices of commodities, soybeans in that case, for delivery and shipment out of the Gulf being at a higher rate. Next slide. This is just continuing to build on the theme here, where we're showing from USDA data on U.S. Gulf vessel loadings, actual loadings of vessels in the Gulf. And the line that runs across, that's the 4-year average. The purple bar is current year, and I believe the other one was the year before. Is that right?
That's due in the next 10 days, so it shows
yeah,
kind of
yeah,
that
right.
we got a lot of boats coming in, but we're not loading very many.
Right. So it shows that the pent-up demand on the light blue and the 4-year loading average versus actual, which, as Jessica alluded to in the prior part of the discussion, is about 25% less, which coincidentally corresponds to the lighter load that the barges were actually able to carry as well. So there are also global responses to the difficulties that we experience and the challenges that we have with the river system and the inability or the disruptions here. So on the chart in the right, we've got China's share of global grain stocks by commodity. And these are the best estimates that folks can really come up with in terms of estimating China's grain reserves. But you see the various commodities. The lower red line is soybeans, and the chart itself doesn't really reflect this, tremendously because of the scale. But one of the observations that we've seen here in the last year is that China has begun selling some of its soy reserves domestically. And it arguably is reflective of a couple of things. One is the general unavailability of soybeans out of South America at this time, but also the effects of Mississippi River situation that we're seeing with the disruption in the short term. Before getting to this and an invitation, one of the things that, from a NAGA member perspective, is the critical nature and role that the river system plays in supporting exports of U.S. agri-bulk commodities from this country. Jessica showed you the investments that are made in this river system provide farmers and the entire industry with a competitive advantage. And it is about maintaining the resilience of the infrastructure. The NAGA members continue to demonstrate that when we face similar kinds of situations with hurricanes. You have these disruptions that occur. I think that one of the issues on the table in terms of contract performance in the future side and the relative commercial viability of the river is the industry has the capacity to respond very well to these short-term kind of events. And we talked about this in terms of what is this event. And so investments in the river and continuing to support this incredibly robust commercial channel is important for the economy, but it also is important for, I think right now, the performance of the underlying futures contracts. It does beg the question, if this is a long-term trend or if this is also just a short-term situation like we deal with in hurricanes or other weather events. Finally, the North American Export Grain Association does have online and available to anyone a library on food security. It covers anything from summaries of the last COP in Egypt related to climate change to information related to global food security and other issues of interest to the trade. With that, we can take questions.
Thank you, Tom and Jessica. Are there any questions from any of the members participating in person? And yes, Buddy Allen, you have the floor.
Thank you, Chairman, Commissioners, Bridget, all the collective staff that support us. We really appreciate the opportunity to be here and convene. Glad to be in person. Jessica and Tom, that was outstanding. I'm with the American Cotton Shippers Association based in Memphis. My office overlooks the river. I've seen this. It's truly something to behold. It's a phenomenon of nature. Related, we don't ship any cotton on the river, but I can certainly appreciate how supply chain disruption causes market risk. And I think very related to the topic you have so well described is the ongoing work by the Federal Maritime Commission right now as they make rules and implement the Ocean Shipping Reform Act. So whether it's chassis provisioning, categorical denial of service, redefining the rules for detention and demurrage, I think would be valuable subject matter for this committee to consider as we move forward. And while I have the mic, a related idea that I had listening to the insightful comments earlier concerning the renewable fuel obligations from EPA, I know that I and several of my colleagues who I've discussed this with on this committee are struggling to reconcile those numbers to the administration's broader sustainable aviation fuel grand plan. And I think if we could focus resources to learn more about that, it would be worthy of consideration. So I would appreciate that, Mr. Chairman. Thank you.
Thank you, Buddy. Do we have any other questions from any of the members participating in person?
So just one comment, again, an excellent presentation, but the impending impact of what's coming is crop nutrients. And so as we talk so much about the southern bound traffic, the northern bound traffic and availability of crop nutrients for what's coming is right in our face right now. And I would hate for that to be lost in this room. Farmers rely on crop nutrients to produce. And if we don't fix the river problems, it's going to spiral. So I just want to make that point.
Thank you, Joe Barker. Do we have any more comments or questions from anyone participating in person? I do not see any questions from any of the virtual participants. Does the chairman or the commissioners have any comments? Yes, Commissioner Johnson.
So first, I just want to say thank you so much for this tremendously rich and helpful presentation, Tom and Jessica. We will have closing remarks, and I'll say then again, also thank you to everyone else. A very rich and thoughtful day. But here I have to be a little more personal than I might have been in other contexts. I think you guys are preaching from my sermon or singing from the same page in my songbook somewhere, because we as a commission have been focused and thoughtful about the water level issues. And just ahead of the break, or just during the last break, I was having this conversation with Dr. Nickerson and others, and just want to emphasize, and I appreciate, Jessica, your linking this presentation to the earlier presentations for the following reason. Macroeconomic indicators do not happen in a silo. The reality is things that are occurring in one area of markets, just as Buddy has mentioned a moment ago, even if it's not the case that cotton is shipped on the river, there are direct impacts ultimately that could come, or indirect impacts from correlations in how different assets function in markets. And so one of the things I'm very deeply thoughtful about and really hopeful hopeful that I can be supportive to the chair and this committee in considering and reflecting on is this interconnectedness. And also to my earlier question, sort of the reality of sustained and persistent changes in macroeconomic indicators and conditions that can't be seen as a snapshot or a singular shock when the reverberations of that shock persist for a period of time that's a year or 2 years or 3 years. I also found the data very compelling that you shared, Jessica, regarding infrastructure investment by other countries who are competitors in markets where we have had a comparative advantage historically. That was very useful and I think tremendously important for us to be thoughtful about. Finally, I feel like I would be remiss if I didn't just say a very positive word about the Army Corps of Engineers. You referenced this in your presentation, and I just want to emphasize our thankfulness as a nation for their continued efforts over a period of time that is some 200 years now in ensuring inland waterways are functional and facilitate the successful production and distribution of agricultural and other goods. I think that it's easy to lose sight of the work that they do. Just the naming of it, dredging, doesn't inspire that level of sexy Hollywood interest that might be captured in other contexts. I'll leave you to imagine a couple of spaces we've been navigating that are overly fraught with that salaciousness in the most recent moments. But the work that they do is critical. It is critical to the production of food resources in our nation and export of food around the world. It directly impacts food insecurity in many parts of the world that we're not necessarily covering directly today, but are impacted. So I just want to acknowledge and be mindful about and thankful for the work that they do and the really rapid intervention that they engaged in to ensure the continued access to the Mississippi River over this period.
Thank you, Commissioner Johnson. Any other comments from the commissioners? No. All right, so we are a little overdue. We're past time, so I think we're going to skip the break, and we are going to now let the members discuss potential topics for discussion at the next meeting in 2023. And we can start with members in person if anyone wants to make a recommendation.
Hello, I'm Ed Prosser from the Schooler Company, and I appreciated especially all the comments today. Insightful information. I would like to raise one of the things that we haven't talked about yet today, and it is a byproduct of all the volatility that's been created, not only from climate, but also from the politics, the geopolitical conflicts that we've seen. Our access to FCMs and their involvement in our markets, and therefore our conduit to those contracts that we use to offset risk, were compromised in different ways as we went through that little scary part of the move in wheat. And I think that understanding not only the availability of how many FCM members we have that are participating, their commitment to the business, and as we look forward, where that's going to be for all of the end users in the contract, makes really good sense for us to understand and for the commission to see where that vital function is going to play out.
Thank you, Ed. Do we have any more topics to discuss by in-person members?
Yeah, Bridget.
Thank you.
Okay, so I had an idea as the CME was doing their presentation. They're changing the way they do span margining, and that's going to have it's having an impact on energy today, but an understanding of the industry to see what's coming on the span 2 margining and how it could impact agriculture, I think would be a very informative session. And then there's an overriding fundamental in agriculture right now as states are making different, and we've talked about it multiple times, but just the impact of this biodiesel, renewable diesel, and how that's going to impact the soybean market, I think could be very informative for this committee. So those are my 2 ideas.
Thank you, Joe. Do we have any more comments from members? Yes, Tommy Hayden.
Yeah, I want to echo what Buddy said. I think we should continue to focus on the supply chain issues that we see as
working for a very large container exporter, as Ed does too, I think we should focus on that because the volatility that we've seen and the impact that it has, the price at the farm gate is huge. So I'd like to continue to focus on that.
Thank you, Tommy. Michael Ricks.
Yes, hello. I'm Michael Ricks, and I work with Cargill in Minneapolis. I'm just wondering, one potential area to look at is, and it's always been there, but it seems to accelerate it here in the last 6 months, is just, the strength of the U.S. dollar on a relative basis, what that does to encourage non-U.S. production, and what that does maybe to even reduce worldwide demand simply because products are traded in dollar terms. So I mean, it gives signals to competitors that to expand production and maybe consumers to reduce. Maybe it's something we can look into more or not. It does impact exports, and exports seem to have an outsized impact on market movements just because they're more volatile than domestic demand. So just some thoughts.
Thank you. Yes, Liam Smith.
Yes, playing along with some of the other comments that got made, to add to that, probably large single execution events happening in the marketplace. That's probably worth looking at, both in exchange level and OTC, around kind of the sizing, associated costs, as well as some of the other things of how that data is disseminated to the entire industry. I think probably worth it could be bolted on to some of the stuff since it does correlate back to some of the other topics.
Thank you, Liam. Do we have any other topics for discussion by members in person? Robbie Boone?
Yeah, I'll just add, I applaud the Commission's interest in infrastructure lending. We've coordinated a rural infrastructure coalition for a number of years called Rebuild Rural, which NGFA has been a member of, and there are a lot of issues out there for rural communities. Understand there can be some jurisdictional impact or things to think about, but certainly a topic worth considering for down the road. Thanks.
Thanks, Robbie. Anyone else in person?
Carbon credits and the markets around carbon credits and some of the things there. I think there's still some gaps in understanding of how it might work, what those contracts will look like, and then speaking from a lender perspective, how we're going to get tied into some of this long term as well.
Could you just expand upon, specifically you're saying carbon credits and what those contracts might look like?
Yeah, what they might look like, what the expectations are, maybe from companies, kind of what they're looking for from that standpoint, what the expectations on farmers would be. Because that's one question we get a lot in the lending community is, well, should I sign this contract or not? How will it change my practices? Are there going to be advantages as a borrower? Things like that. So just kind of filling those gaps in between.
Thank you. Any other comments from members attending in person? No? Okay, I see we have a hand up from Mr. Mark Mahargu, who's attending virtually.
Well, thank you. Mark McCarg, representing American Farm Bureau, a farmer here in Nebraska. One of the things that we've been talking about fairly significantly is just the potential cyber attack threats on agriculture. It doesn't seem like we have a concerted group that is watching that as far as the industry as a whole. We're concerned that if we do have attack on potentially our equipment, maybe during planting season or harvest season, that certainly could influence the markets, and a bad actor could take a position in the futures market and take advantage of a market move. And so I think just some conversation about how we protect against some of those threats. And then I would agree with some of the conversations, maybe not around carbon trading, but just the conversation of carbon intensity scores and how that affects on, again, probably in the financial sector, banking sector, the burden on agriculture of having to potentially come up with those scores and some of the sustainability scores that we may be burdened with and how that affects the market. So thank you.
Thank you, Mark. Do we have any more? I'm just looking comments from any of the members attending virtually. And last call for anyone in person. No? We We have a couple minutes left. If anyone is interested in proposing a couple dates for our next meeting in 2023, we would be open to hearing that right now.
Just a point of inquiry. Is the Kansas State CFTC event going to happen in April? Has there been any discussion of that?
We're not going to be able to do it in at least spring of 2023. We're going to look at potentially fall of 2023, and then practically speaking, 2024 becomes, as you can imagine, it's a bear of an event to organize. We have to get through some appropriations issues and work from there. But certainly appreciate, and I would think that most of all of you enjoyed that event. I did certainly. I know this would be new to most of the commissioners here, but we're going to try our best to get it back on board as soon as possible.
Thanks for raising that, Joe Barker. Do we have, yes, Willis Kidd?
Just a comment on the timing. Dr. Nickerson mentioned it, that she would have been able to have an analyst or two here if it was not so close to the USDA reports. And so maybe a suggestion that these are held a week after the USDA reports instead of 2 to 3 days before. I know some of us that come into town, we would have had meetings with people at USDA if it wasn't so close. So.
Thank you. Do we have any other comments or date proposals for our next meeting in 2023, either from in-person members or virtual members attending virtually? No? Okay. Well, the meeting does end in 4 minutes, so okay. We'll skip to the chairman. Would you like to make a? Okay. Yeah, let's start with Commissioner Goldsmith-Romero.
Like I said, this was great. You did not disappoint. I'm very grateful for the information that you shared today, and also just how it impacts, how everything we talked about really impacts not only our markets, but our economy. I mean, I worked at Treasury for 12 years before coming to this job, so I tend to think about all of these issues as they impact our economy, and I thank you for bringing that home in all of the presentations today. So, I mean, we have consumers facing increased costs and either delays or an inability to get the goods that they need, and our businesses, our agricultural businesses and others are facing the same thing. And so understanding with granularity how these specific events, whether it's related to the drought, or related to Russia, Ukraine, China, or the ongoing supply chain issues. And I appreciate you raising the labor issue, which is something that has come up in several discussions with me. How that in granularity is actually carrying through to impact businesses and consumers is really important. And I'm glad that was brought out today. So I'm grateful for us as a commission focusing on what I see as the backbone of what we do, the core part of our mission. And I want to make sure that you understand that's a priority to us. So you could read speeches and we can talk about digital assets or other things, but this is never anything that's on the back burner. This is something that I work on every day, get up and look at markets and are paying attention to what's happening, and I care about what you care about, and will always endeavor to keep that as a priority. So I'm grateful to be here today. Thank you for the chairman. Thank you for Bridget and my fellow commissioners for your input, but really, really grateful to have this time to share with you, and my door is always open.
Thank you, Commissioner Goldsmith-Romero. Commissioner Mersinger?
Just to echo Commissioner Goldsmith-Romero, thank you all for being here. I know this is a time commitment, and you all have very important day jobs, so we always are appreciative of you sharing some of your time and knowledge with us so we can better do our jobs. I have to say today, this conversation is probably one of the more comfortable conversations I've been in, where I understood all of the acronyms. I most I pretty much was able to follow what folks were saying. I got really excited when they started talking about WERDA and NESPA, and you know, we could go on and on about Army Corps of Engineer, river management, especially as someone who lived upriver, and there's certainly some competing interests from those who are upriver versus those who are downriver. But it was a great discussion, a lot of interesting information shared today, which is stuff that we don't normally get to see. So I thought that was incredibly helpful. And just based on some of the ideas that came up for future topics, I am definitely looking forward to the next Ag Advisory Committee meeting. So just thank you again, and look forward to seeing everyone again next meeting.
Thanks, Commissioner Mersinger. Commissioner Johnson?
Thanks so much, Bridget. Thanks so much, Chair. Thank you to everyone who did take tremendous time out of your very busy schedules to join us here today. I am a native Michigander, and though my family didn't have a farm, my grandma grew strawberries, and that felt like something big when I was tiny, and we like gathered them every summer at the end of the summer in her yard. I grew up in Texas, though, and spent a lot of time in Georgia, and am deeply thoughtful about all the issues that are top of mind for each of you. I really echo Commissioner Mersinger's reflections. She described getting excited about, I would just say I nerd out on all things risk management, and I don't know that there is a business, or I have to just explicitly say, among the most risk management intensive businesses is certainly agriculture. When I taught as a law professor derivatives and commodities law, the example I begin the conversation with is an agricultural derivatives example. I talk about Aristotle writing in ancient Greece about thales, and I describe contracts for access to an olive press, which is to say, from the earliest civilizations, this has been one of the most critical industries in market infrastructure. It's been one of the most critical industries in at the center of our economy, and I just am deeply appreciative of the hard work that it takes every day to deliver food to the nation and around the world. And I think that is something that really deserves every minute of the time we took today and even more. So thank you for your expertise, your knowledge, your experience, and being so generous as to come and to share it with us, and for the act of public service that you've undertaken in agreeing to serve on this committee. I think we as a commission are tremendously grateful, and I think the nation is very well served by your participation.
Thank you, Commissioner Johnson. Go ahead, Chairman.
Thanks. I'll be brief. Just, first of all, thanks to all the speakers. Great presentations. I think timely, obviously, given what we're dealing with globally and from a markets perspective. Also, just echo thanks for being here. This is a good group that I think we're going to obviously be able to add a lot of dynamic conversations over the next couple of years. And I think, you know, the ideas that we've even suggested in the 5 or 10 minutes, that's a few meetings right there. But they're all critically important. I was thinking about, we got a farm bill coming up next year, and the interconnections, not only, Robbie, you mentioned jurisdiction, right? But they're whether it's the Maritime Commission or any other EPA, farm credit, we have that ability and that need to convene and bring our friends here. And, thanks to USDA for being here. They're certainly a huge partner in our efforts. So we'll continue to think about these issues and see if we can get some of our sister agencies outside of the financial market space to help and contribute and to give us ideas about what they're doing so that we can be better informed about our rules and regulations. But last thing I'll say is, we're gonna need a chair. So to the extent that one of you is willing and desires to be in that position, let me and Bridget know. Or if you have any recommendations of your colleagues who you think would be a good chair as we get into 2023, please feel free to send us a name or two. That will be obviously a critical component of leadership and getting these issues out. So lastly, I just do want to thank Bridget and everyone who helped put this together. Bridget is based out of Chicago, so she was kind enough to come out here. And many of you have probably worked with Krista Lackemeyer a lot over the years. Krista unfortunately left us a few months ago. but we are in good hands with Bridget. She's been a DMO for a number of years. She knows ag markets well, and we're going to be able to make sure that we prioritize these issues and, of course, be responsive to all of you, whether from a markets perspective or a commercial perspective. So with that, thanks for your time, thanks for your patience, thanks for your service, and look forward to 2023 and digging into a lot of these issues.
Thank you, Chairman. The meeting is now adjourned.